Good morning, everyone. So yes, let's begin our session of today. And today's session is really important, guys. Today's session is related to salaries chapter. So yes, for CMA Intermediate students, salary chapter is one of the most important chapters of your syllabus, one of the lengthiest chapters also of your syllabus. And yes, guys, you can expect questions up to 10 marks from this particular chapter, even up to 15 marks. So guys, as far as I remember, in the last attempt, section D, the case study section, was entirely based on the salary chapter. So salary chapter is one of the most important chapters of your syllabus, and you really need to do this chapter wholeheartedly, very seriously. It's a lengthy one. There are a lot of computations. There are a lot of provisions which are there in this particular chapter pertaining to the rules as well as the sections. So you need to mug them up, you need to revise them, you need to learn them really properly, and you need to practice them. Okay, it's not about mugging up the sections, it's about practice. How well you practice those computations, those exemption computations, that is what is relevant in this particular chapter. So yes, with hope in mind that yes, we are going to conquer June 2022 examination. Yes, let's start our live session of the chapter salaries. Okay, so first let me give you an overview of what salary will entail for all of us, right? So these are the broad framework, these are the broad sections which we'll be dealing with in our salary chapter. What are those sections which we'll be dealing with? Let's see the sections which we'll be dealing with in our salary chapter. All right, so guys, we are going to start with employer-employee relationship. That is the first thing which we are going to see in the chapter of salary, employer and employee relationship, because employer-employee relationship is a mandatory ask, is a mandatory condition of taxing someone in the head of salary. So the first thing that we are going to study is what is this employer-employee relationship. So if someone wants to tax their the income in the head of salary, so if income tax officer wants to tax income in the head of salary, the first thing which is to be proved is employee-employer relationship. There has to be some binding relationship between employer and employee, where employee is bound to, employee is obliged to work under the supervision, work under the conditions which are laid down by the employer. So that is the employer-employee relationship. So why do we need to judge whether this income is salary or not? So how would it matter? I mean, even if someone is earning business income, and even if he says that, oh no, I'm not earning business income, I'm earning salary income, how would it matter? It's okay, sir. Why to classify some income as salary? Why do you need this classification? Guys, the reason is very clear, that these different heads of income have different tax rates, have different deductions, have different exemptions, have different computation mechanism of computing their taxable income. So we cannot intermingle them, we cannot juggle between them. So if someone is earning PGBP income, then he will be taxed under PGBP. If someone is earning salary income, he will be taxed under salary. If you become over smart, if you want to take more benefits of salary chapter, and if you become over smart and you tell me that, although I am earning business income, but I want to offer it to tax as a salary, then I would require you to fulfill this first condition. Only if you fulfill this first condition, you will be eligible to claim all the benefits of salary chapter. But if you fail to prove to me that you are earning salary, you fail to prove you are an independent contractor, you are an independent person, you're not working under someone, and you fail to prove to me that you have any employer-employee relationship, then I will tell you your income will not be taxable as PGBP, your income will be taxable as salary. So to identify, to classify the income as a salary, the first and basic condition is that there has to be an employer-employee relationship, which means someone should be bound to work under the supervision, under the instructions of someone else. So employer-employee relationship, someone should be bound to work under the supervision, under the guidance of someone else. That is the employer-employee relationship. So yes, first we are going to discuss the definition of salary. Then we are going to discuss what do you mean by allowances and perquisites. These are two basic things which we are going to discuss. What are allowances, what are perquisites, and yes, last, what are retirement benefits. So these are the three elements of salary. Apart from the basic salary, there are allowances, there are perquisites, there are retirement benefits. What do you mean by allowances? Allowances means when the employer gives some money in cash form, okay, in bank transfer form, in money form, to meet certain expenses of the employee. That is known as allowances. So allowances are monetary payment for some specified purposes, to meet certain specific expenditure, employer gives some money to the employee, that is known as allowance. Now again, guys, whatever allowance is there, so for example, I stay in say Lakshmi Nagar, okay? There is a area in Delhi known as Lakshmi Nagar. I stay in Lakshmi Nagar, okay? The usual rent which is there in Lakshmi Nagar for a 2 BHK is say 20,000 rupees. But my employer gives me an allowance of 30,000 rupees. Okay. So for recuperating my expenditure of rent in Lakshmi Nagar, my employer is giving me how much amount? My employer is giving me 30,000 amount. Okay. However, the rent which is there in Lakshmi Nagar area is only 20,000 rupees. So the employer is actually giving me a higher amount of rent. He's giving me a higher amount of rent. So for recuperating or reimbursing my rent expenditure, my employer is giving me 30,000 rupees. However, my reasonable rent which is there in Lakshmi Nagar area is 20,000 rupees. Then guys, the Income Tax Act is very, very clear. It is saying that whatever is a reasonable amount of allowance, the reasonable amount of allowance is 20,000 according to the Income Tax Act. So whatever is the reasonable amount of allowance, that will be exempt from tax, and whatever is the remaining amount, that will be taxable as if salary has been given to you. Obviously, guys, this is unfair. For meeting an expenditure worth rupees 20,000, employer should not give 30,000 rupees. He should not give extra allowance. Why is he giving extra allowance? To curb this situation, to curb this over smartness done by the employer, what Income Tax Act will do? Income Tax Act will specify the amount of exempt allowance. Whatever amount according to the Income Tax Act is a reasonable amount for this particular expenditure. Meeting this expenditure, the Income Tax Act will give that particular amount to you, and the remaining amount will be taxable allowance. So wherever allowance will be given in the question, the ask will be, the question which will be asked from you will be, what is the exempt amount of that allowance? That is the question which will be asked from you. And yes, Income Tax Act has specified rules and regulations and provisions with respect to calculating what is the exempt amount of the allowance. So that is how allowance are to be treated. And yes, guys, in some of the allowances, the Income Tax Act says that nothing should be exempt, everything should be taxable. So for example, if for meeting certain personal expenditure of the employee, like any servant of his home, if employee has hired some servant at his home and employer is reimbursing the salary of that servant to the employee, then that is personal expenditure of the employee. And if employer is reimbursing that, Income Tax Act says nothing should be exempt. The entire amount should be taxable as salary of the employee. We will assume that employer is in effect giving salary to the employee. So entire amount will be taxable. Nothing shall be exempt. And guys, in certain genuine cases, in certain perfect cases wherever the genuinity is proved, in genuine cases, there may be a situation where the entire amount of allowance is exempt and nothing is taxable. Income Tax Act will say, okay, this is the genuine allowance which is being given to the employee. This is absolutely genuine. I will not tax any part of it. Entire amount will be exempt. So 30,000 allowance is given. Entire 30,000 will be exempt. So taxable amount should be nil. So these are the three categories of allowances. Let's read the three categories of allowances which you'll be studying in our syllabus. Category number 1, fully taxable allowance. Category number 2, partly taxable allowance. Category number 3, fully exempt allowance. All depends on genuineness of the allowance. All depends on what amount does Income Tax Act feel is genuine for this particular expenditure or this particular allowance. That particular amount will be exempt in hands of the employee. The balance amount will be taxable. As I've given you the example, guys, 30,000 has been given by the employer to the employee for rent expenditure in Lakshmi Nagar, but in Lakshmi Nagar only 20,000 rupees is the genuine expenditure. Okay, so the balance 10,000 rupees, which is excess reimbursement or excess allowance, which is given to the employee, that particular excess will be taxable as what? As salary in the hands of the employee. And yes, guys, the reasonableness will be decided by the Income Tax Act. You cannot tell me, oh sir, no, this is not reasonable. Income tax act is wrong. You cannot say this. You cannot say this. The reasonableness of the expenditure is decided always and always by the Income Tax Act. Income Tax Act, in its wisdom, will decide what is the amount of reasonable allowance that should have been given. And if anything over and above that amount is given to the employee, then that will be taxable as salary. That is the principle. Okay, sir. We'll be dwelling into the details of this particular allowances in the later part of this video. Then comes perquisites, guys. Perquisites, in case of perquisites, no cash is given to the employee. Nothing in cash is given to the employee. Nothing in cash is given. Monetary benefit, monetary emolument, monetary consideration is not there in this particular case. It is all non-monetary benefit. It's all non-monetary benefit. Non-monetary benefit means you are given that particular facility. For example, if you want a house to live, instead of giving you the rent amount, the employer will give you the house. You please stay in that house. He will not transfer the house in your name. No, he's not transferring the house in your name, but he's asking you to use the house for as many days as you are my employee. You take the house. So, for example, if you want a car, then instead of reimbursing the expenditure of car to you, employer gives you the car itself. So in case of perquisite, these are non-monetary benefits. No money is given to the assessee, only some asset is given to the assessee or some benefit is given to the employee, and that particular amount is definitely considered as either taxable or not taxable in the eyes of the income tax law. Now income tax law will decide that if you have been given a motor car, if the employee is being given a motor car, then Income Tax Act will decide how much amount should be taxable in the hands of the employee. Income Tax Act will decide this. If the employee is given a rent-free accommodation, there is a big house which is given to the employee. Without any rent, he is staying there. Without any rent, he is staying there. Then Income Tax Act will decide how much amount should be taxable in hands of the employee. This is the responsibility of the Income Tax Act. So guys, in case of perquisites, exempt amount is not calculated, but taxable amount is calculated. In case of allowances, exempt amount was calculated. So you get an allowance, right? You get an allowance of say 30,000 rupees. Then Income Tax Act will tell you how much is reasonable out of this 30,000. Only 20,000 is reasonable because you stay in Lakshmi Nagar. Oh, please come on. Lakshmi Nagar, the rent is only 20,000 for 3 BHK. So Income Tax Act will decide the reasonableness and then it will decide the taxable amount. So in case of allowances, the amount which will be calculated is exempt allowance. And then after reducing the exempt allowance from the total allowance, we'll get the taxable allowance. But guys, in case of perquisites, situation is not the same. You are not getting any monetary emolument. You're not getting any monetary amount. So we don't know what is the amount that you are getting. You are not getting any amount. You're not getting anything in cash. You're just getting an asset. So in this case, Income Tax Act is directly telling you what is the taxable amount of that particular asset in the hands of the employee. What should be the taxable amount? Now, before coming on to the section and before I actually delve into the section and go into the section, I'll give you a very simple, quiz. Okay. And please hear my quiz very, very carefully. Okay. Now, motor car. If suppose a motor car is given by an employer to his employee, if the motor car is given by an employer to his employee and the motor car is only and only used for official purpose, the motor car is used entirely for official purpose by the employee, only and only for official purpose by the employee, please tell me what will be the taxable perquisites? Just your common sense, just your general knowledge. Okay, please write in the chat box what should be the taxable perquisite on the basis of your general knowledge, on the basis of your logic. Okay, I've not taught you the section as yet. I've not taught you the computation as yet. But my question is that if motor car is given to the employee and employee is using it purely for official purposes, he's not using it for personal purposes. He's using it only when he is out of the office for official purpose. Then what should be the taxable perquisite? Let's see who gives the right answer. Right. Well done, mind blowing. All of you have given the right answer. Answer is nil. Ravi Gupta says nil. Pooja Jangman says nil. Sumit Kumar nil. Chirag, no perk, is it? Not taxable. Official purpose means no perk taxable. Satish Kumar, brilliant. Swarna, Madula, brilliant. Nil, absolutely correct, guys. You are absolutely right. So the logic behind, please let me repeat, the logic behind taxing perquisite is that if any perquisite or any benefit which is given by the employer to the employee is used for his personal use, then that perquisite is taxable as salary in the hands of the employees. The logic behind taxing perquisite is that if any perquisite is given by the employer to the employee and the employee uses it for his personal use, then guys, that particular perquisite is actually taxable in hands of the employee. If the perquisite or the asset or the benefit is only and only used for official purpose, then there is no perquisite. If the benefit is used for personal purpose, then there is taxable perquisite. So if any benefit is extended by the employer to his employee, any kind of asset is given, any kind of benefit is given by the employer to his employee, and the employee uses this only and only for official purpose, no taxable perquisite. We only tax perquisites when they are used for personal purpose of the employee. If the employee is being naughty, if the employee is being malafide in his intentions, if the employee is doing something wrong, he's misusing company's assets, then we tax the perquisites in hands of the employees when he's using it for his personal purpose and not for his official purpose. That is the logic behind perquisites and taxing perquisites. And last but not at all the least, retirement benefits. Guys, retirement benefits means there are certain emoluments, there are certain benefits which are given to the employees post-retirement. Post-retirement means, in India, there are two ages, 60 and 65 for certain professions, certain officials. So either you attain age of 60 or 65 in your respective professions. After attaining the retirement age, you get some amount in lump sum, some amount in totality, or some annuity is given to you. That entire amount is known as retirement benefits. So retirement benefits is nothing but the emolument or the benefits that an employee gets after his retirement, and that is taxable in hands of the employee. Of course, some soft corner is given to those employees because retirement benefits are once in a lifetime benefit which are given to the employees. So some soft corner is there. Exemptions are there for gratuity, for provident fund, for leave salary, encashment, pension, etc. Some exemptions are definitely there for a certain amount of retirement benefits that we'll see in our chapter. So guys, these are the primary areas of study in this particular chapter. And yes, this was the entire chapter in very, very, very brief for all of you. Now we come on to the first aspect of our salary chapter. The first aspect is employer-employee relationship. What do you mean by employer-employee relationship? That is what we are going to see now. So employer-employee relationship means someone is bound to work. There is a master-servant agreement. There's a master-servant agreement. Someone is bound to work for someone else. Someone is bound to work for someone else. That is known as employer-employee relationship. Then payment in employer's capacity. So whatever amount is being paid to the employee, it is being paid in employer's capacity. Employer means a person who has employed the other person, a person who has supervision and control on the other person. That person is employer, and that particular person is paying emoluments to the employees. So payment is in the employer's capacity. That is the second element of employer-employee relationship. And guys, you have to demonstrate this, that you have employer-employee relationship if you want to get yourself taxed under salary head, right? So, you can't be over smart. You cannot say that, oh, although I am earning PGBP income, but let me tax myself in salary. You cannot do that. No, you have to demonstrate employer-employee relationship. Then one very important aspect of employer-employee relationship, contract of service or contract for service. Contract of service means you are ready to service that particular other person, and you are in full-time service of that other person, and you are under contract of service. Then you are bound under employer-employee relationship, which means you are ready to serve the other person for a full-time basis. Okay, on a full-time basis you are ready to serve other person. So contract of service means where I'm someone else, contract of service. Okay, and contract for service means that I am not working full-time with someone. I have taken some work from. So for example, if I employ a person to maintain all my ACs. I have ACs in my office. I have 6 ACs in my office. I employ a person. You please wash all these ACs. Please service all these ACs because summers are approaching and I want to use all of them. Okay. He tells me, sir, I will take 2 days to finish the entire work. I tell him, you take whatever days you want to do. That is none of my concern. I will pay you a fixed remuneration of say 500 rupees per AC. That's it. You take 2 days, 3 days. I don't care. Okay. Just maintain my ACs. All the ACs should be maintained. Guys, this is contract for service. This is contract for service. I am hiring the service and I'm not bothered about what time does he take. He can take as many time as he want. I'm paying for his service. Now, example number 2 versus this example number 2. I keep someone full time in my office for editing my videos, for graphic designing my videos, for designing my thumbnails, for designing everything that I have in my YouTube channel or my Instagram or my LinkedIn. To design everything, I have hired a person on a full-time basis. He's working with me from morning 10 a.m. till evening 7 p.m. This is his work timing. And during the day, I can ask him to do anything and everything. It is not that I will give him a fixed area of work. I can ask him to do anything and everything. He can also amend my books of income tax. He can incorporate amendments in the Income Tax Act in the book. So he can do anything and everything. In that case, the service is contract of service. And only contract of service is employer-employee relationship, because during that time, the person is bound to work as instructed by me. In the initial case, as I discussed with you, in the initial case, guys, the AC repair mechanic is not bound to work according to me. He is free to work as much as he wants. He is free to do whatever he wants to do. At the end of the day, I want the output. Output is that AC should be maintained. Even if he doesn't work for 1 day or 2 days, I don't care. Okay, he will work for 3rd day and 4th day. I don't care about it. But in case of contract of service, I definitely care as to what is the opening timing of that particular person, closing timing of that particular person. Is he working well or not? Is he working fine or not? I want to actually monitor all those things in contract of service. So contract for service, contract of service. In case of employer-employee relationship, there is always contract of service, where I am hiring someone to work for me. Anything, I can give him any work. Okay, that is employer-employee relation. Then last is no agent principal relationship. So guys, agent principal relationship means you must have seen franchisees. Okay, McDonald's, you must have gone to McDonald's store and eaten burgers, and Happy Meal, you must have eaten from burgers to French fries to cold drink. Happy Meal you must have eaten several times. And in earlier times there were toys which used to come with Happy Meals, and I used to collect those toys a lot. Now Happy Meal is devoid of the toys, so be it. So guys, these McDonald's are working as franchisee of their parent company. They are independent people. They are working under supervision of their main principal, but they are not bound to follow instructions 100% completely or guidance of their principal person. They are agents of their principal. So still, after being agent, they are free to be agent of, say, Starbucks also. They are free to be agent of, say, Pizza Hut also. They can be agent of several people. So if you are an agent of a principal, yes, to an extent, you are bound to work under directions of the principal. If you are an agent, you are bound to work under directions of the principal. That is very true. But guys, this will not lead to employer-employee relationship. So principal-agent relationship doesn't lead to employer-employee relationship. Since it doesn't lead to employer-employee relationship, the agent-principal remuneration will not be taxable as salary. So for classifying the income as salary, you need to have employer-employee relationship. Agent-principal relationship is not employer-employee relationship, and therefore not salary income. Okay, sir, got it? Okay, so guys, there are certain incomes which are, I've given some examples of incomes which might be salary, which might not be salary. Let's see. These mostly I've given the examples where salary is not there. Okay, let's read these examples. Okay, we'll have to see whether the relationship is employer-employee or not. Okay, if the relationship is employer-employee, we will say yes, it is salary. If the relationship is not employer-employee, we will say it's not salary. Okay, that is the deal. Okay, sir. First, salary of a partner. So guys, you must have heard of partnership firms. Okay, partnership firms have partners. Salary of partner, whether it is a salary or not, whether it is taxable as salary income or not, to answer this question, I would first of all ask you, please tell me whether partner and partnership firm, they are employer and employee, or they are one and the same thing. I want the answer in the chat box. My question is, partner and partnership firm, whether they are employer employee, or they are both same. I mean, in eyes of law, they are both same. The partner is unlimited, has got an unlimited liability, and whatever liability the partnership firm has, partner has to fulfill that liability from his personal assets as well. So is there an employer-employee relationship between partner and partnership firm, or both partner and partnership firm are one and the same thing under law? Both of them are equal under law. That is my question to you. Absolutely, Khushi is right, Garima is right, Achal is right, Jyotish is right, Anshika right, Suman right, Chirag right, Pooja right, Deepak right, Garima right, CMA Bhakt same right, very good. Deepika Purohit, Kartike Mishra, Dhruv Jain same, perfect. So my next question is, will the salary given to a partner from the partnership firm be categorized as salary or not? Yes or no? There is no employer-employee relationship. So will it be categorized as salary or not? Will it be salary or not? Answer is no, it will not be salary. It will be taxed at as PGBP. It is income from PGBP. It is not salary. Perfect, guys. Perfect. Clapping for all of you. Clapping for all of you. Brilliant. Brilliant answers. Achal Singh, Jyotish, Akash Chabra says no. Miraki says no. Jia Chaudhary, no. Swarna, no. Perfect. Manav Khera, no. Perfect. Let's move on. Salary of proprietor. Okay, there is a proprietorship firm. There's a proprietor. Proprietor means he is the owner of the business. Okay. Again, same question. Proprietorship firm and proprietor, are they employer-employee, or they are one and the same thing under eyes of law? Are they employer-employee? Are they two different individuals, or are they one and the same thing? That is the question. Give me the answer in the chat box. Chirag Khemani, Muthu Kumar, perfect. Swarna, perfect. Chirag Khemani, Yashika Jotwani, Vanshi, Aditi Garg, Akash Chabra, Khushi, Devashi, same thing. Perfect. Again, my question is, salary of proprietor. Will it be income under the head salary or not? Will it be income under the head salary or not? Answer is no. It will not be income under the head salary. So guys, brilliant answer, brilliant analysis. That is how you need to analyze in future also. Okay. एकदम सेम टू सेम. ये कौन बोला एकदम सेम टू? हाँ, ये आकाश छावरा बोल रहा है एकदम सेम टू सेम. नालायक. Okay, remuneration to directors. Now guys, directors are of two types. First, independent directors who are not employees of the company. They are not bound to work under the supervision, under the instructions of the company. Independent directors. Number two, employee directors who are required to work under supervision of the company. Okay, independent directors, not an employee of the company. They are not required to work under supervision of the company. And the employee directors. Answer is very clear. In case of employee director, there is an employer-employee relationship, hence salary. In case of independent directors, there is no employer-employee relationship, therefore income from other sources. IFOS, income from other sources. Perfect. I hope there's no problem. No problem, sir. Next. Pension to widow or the legal heir. So, you know, an employee dies during his duty or after his duty, he dies. So the pension is given to his widow, his wife, or his legal heir. Now guys, the person who died, he had employer-employee relationship. The person who died, he had employer-employee relationship. But his survivors, like his widow, does widow also have a relationship of employer-employee with the company? Does widow also have relationship of employer-employee with the company? Yes or no? In the chat box, please. Answer is no. Widow doesn't have the relationship, or the son or daughter doesn't have relationship of employer-employer with the company. Therefore, income of widow is taxable as IFOS, income from other sources. Perfect. Kartike, Deepika Raj Purohit, Suman Bharti, Mohammad Azam, Amal Raj, आंचल सिंह राजपूत, पंकज, दीपिका राज, पंकज आज लेट आए, जरूर लेट सोया है रात को, कल रात को लेट सोया है, पता नहीं क्या कर रहा था यूट्यूब पे, तभी आज सुबह सुबह इतना लेट आया पंकज। अदिति कुमारी नो, विनय कुमार रेड्डी नो, नो रिलेशन ऑफ विडो, परफेक्ट परफेक्ट, वेरी गुड गाइज। नेक्स्ट, रेम्यूनरेशन टू जजेस, remuneration to judges. Now let me tell you a very important part about judges, guys, a very important part about judges. Judges are not employee of anyone. Judges are not employee of anyone, because if judges are employees, if judges become employees, then they become dependent. Their independence is impaired, because if they get salary from the central government, then they will be biased towards the central government, right? So judges, typically it is said that judges do not get salaries. They are not employees. But guys, in case of judges, even when they don't get salary, even then they are taxable as salaried class employees under the Income Tax Act. Okay. So under Constitution of India, under the Constitution of India, the judges do not get salary under the Constitution of India. Okay. But Income Tax Act says that no, even when they are not termed as salary, but it is taxable as their salary income only. So this is one very rare exception, one very rare exception which Income Tax Act has carved out, that even when judges do not get salary, even when judges do not have employer-employee relationship with the government, still their income is taxable as salary. Even when they don't have any employer, their income is taxable as salary. Because guys, I'll tell you what, Income Tax Act goes into substance over form. Income Tax Act goes into substance of the material, okay? And the substance, in substance, yes, it is not termed as salary so that they are not impaired, so that their independence is not impaired. We term it as salary. But in substance, guys, it's their salary only, in substance. So Income Tax Act taxes remuneration of judges as salaries. Then remuneration of teachers. Now this is a very, very important aspect, guys. So you must be passed out from your schools and colleges. There are teachers, right? The teachers who are there, their remuneration is received from the school or the college. That is salary, okay? So, you know, I belong to Kironimal College, Delhi University. So whatever our teachers used to get as salary from the college, that is known as salary. That is taxable as salary. That is salary income, okay? But, you know, once a year, university, Delhi University calls all the teachers for a special program, for a special assignment of checking papers of the university annual examinations. So guys, over there, the teachers are paid on a per paper basis. So for each paper, they get say 20 rupees per paper. There is no salary. There's no employer-employee relationship. Teacher can say, no, this year I'm not going to come. Teacher can say this. There's no employer-employee relationship. When university is calling the teacher, so when college is calling the teacher, college and teacher has employer-employee relationship. School and teacher has employer-employee relationship, but university and teacher do not have employer-employee relationship. It is teachers' will whether they want to check the papers or not. Okay. So in case of university, when the teachers get remuneration for checking papers from university, it is taxed under IFOS, because university and teachers do not have employee-employee relationship. University and teachers have an independent relationship. They are working on a consignment basis, on an assignment basis. Therefore, it is taxable as IFOS. Last but not at all the least, member of parliament. Guys, member of parliament are not employees. They are not employees. So their income is not taxable as salary. Their income is taxable as IFOS, income from other sources. But yes, guys, judges and member of parliaments, you know, they get some extra benefits apart from the regular people. They get some extra benefit, which we are going to study in our respective chapters. So yes, these were certain examples, guys, and these are very, very important from MCQ standpoint. Your MCQs should be very, very clear, and they should be giving out all these concepts very well. Okay. Ravi Gupta says, for checking paper without employee-employee relationship, not taxable as salary. Perfect, Ravi. Very good explanation, Ravi. Very good. Brilliant. I am proud of you, Ravi. Although Ravi is giving examination in December 2022, and he can actually, you know, he has done his entire syllabus of group 1, so he can actually not study for next 3 years. I know Ravi, still he's studying so hard. So many congratulations, Ravi. Just a joke, guys. Ravi is in our face-to-face batch, so I always, you know, crack some jokes with him. This is of charge of salary. When should salary be taxed? That is the question that we are going to dwell now. When should salary be taxed? Guys, salary is received, can be received as advance salary. Advance salary means, you approach your employer and say that, okay, for next month's salary, please give me in this month itself. That is advance salary. Second is arrear salary for past years. You can get arrear salary for past years. For past few years, you can get salary now. Okay, in the past years, you didn't get those salary because of some dispute. Okay, owner said that no, this salary doesn't belong to you. You said no, the salary belongs to me. So there might be some dispute. So there can be arrear salary of past years. Then there can be outstanding salary. Outstanding salary means the salary which is regularly being received by you. So salary up till say 31st March is given to you on 7th of April. That is the terms between you and your employer. So the salary which is due on 31st of March, which is outstanding on 31st March, that is given to you on 7th of April. So these are three salary which can be received by you. Now, arrear advance salary. Advance salary means you are getting something in advance. It is taxable on receipt basis, that is cash basis. So if I get salary of next 6 months today, I will be required to pay taxes on that salary today. I will be paying salary on cash basis. Similarly, arrear salary, which was disputed salary of past years. So for past 3 years, I'm in dispute with my employer that I should be eligible for a higher salary. My employer is saying you should be eligible for a lower salary. The matter went to court, and court took 3 years to make a decision, and the decision came in my favor, right? So in current year, I got salary for last 3 years. In the current year, I got salary for last 3 years. That is known as arrear salary of past years. So guys, arrear salary of past years is taxable on receipt basis. On receipt basis, the arrear salary of past years will be taxable to you. Yes, sir. And the next one is, next one is, just a second, guys. And the next one is, just a second, guys, just a second. Okay, perfect. All right, let's carry on. Right, so I've talked about two kinds of salary: advance salary, arrear salary of past years. These are taxed on receipt basis. Whenever they are received, they are taxed. Last is outstanding salary, which is your regular salary, which is outstanding as on the last day of the month, and that kind of salary is taxable on due basis. So for example, if your salary of 31st March is due on is outstanding on 31st March, it is payable to you by 7th of April, then guys, that salary will be taxable in your hands on due basis. When it becomes due, it becomes when you are due to receive the salary, that is on 7th of April. So the salary will not be taxable on 31st of March. It will not be taxable on 31st of March. It will be taxable on 7th of April. On 7th of April, that salary will be taxed. So salary will be taxed on due basis. Now, what do you mean by due? Due means when you get the right to receive the salary. When you get the right to receive the salary. So guys, on 31st of March, yes, the salary accrues to you. The salary accrues to you on 31st of March, but the right to receive the salary, the right to actually get the salary in your bank account, that is received on 7th of April. Therefore, the salary shall be taxable on 7th of April. So salary which is outstanding is always taxable on due basis. So these are the three kinds of chargeabilities which are there. Okay, sir. And now we move on to allowances. Yes, one of the most important topics of our syllabus, guys. Allowances. What are the allowances? What kind of allowances are there? Partly taxable allowance, fully taxable allowance. There are three kinds of allowances which we have studied. So yes, let's start this topic. Allowances, most important from the exam standpoint, and in the examination, allowances will definitely come. Definitely they will come. Okay, so allowances are the fixed sum of money amount, fixed sum of money which is given apart from salary to meet particular requirement. So to meet certain requirements of the employee, we give certain money. That money is known as allowance. Now this can be of three types: fully taxable allowance, allowances which are fully taxable; fully exempt allowance, allowances which are fully exempt from tax; and partly taxable allowance, allowances which are partly taxable, which are partly exempt. That is the third category of allowances. And guys, the most complex one is the third, partly taxable and partly exempt, because there'll be a great deal of exemption computation which will be required to be done by you. Income Tax Act will tell you, oh, you have got allowance of 30,000. According to me, 30,000 is excessive. According to me, the reasonable amount is only 20,000, and the Income Tax Act will give you the method of computing this 20,000 as well. So this is how partly exempt and partly taxable allowances will be actually be computed. So yes, this will be one of the difficult parts of your allowances concepts. These two parts will be relatively simpler because these are fully taxable allowances. So these taxable allowances do not require any computation. Entire amount of allowance, whatever is received from the employer, is taxable in hands of the employee. So no need of computing the exempt amount of allowances. Fully exempt allowance, these allowances are absolutely exempt. So these are allowances, if given in as many amount as possible, you give 1 crore rupees as allowance, you give whatever as allowance, that will be fully exempt. Okay, and primarily these are in the nature of allowances which are given to government employees, or SAARC nation employees, or UNO employees, High Court, Supreme Court judges, etc. So primarily these cannot be excessive, okay, because these allowances are always made under the by rules or bylaws of Government of India. They cannot be excessive principally, right? But still, even if they are excessive, they are fully exempt. Now we come on to the to the main part. So yes, SAARC countries, these are SAARC countries which are there. You need not remember name of all the SAARC countries. Okay, residency is to be seen in the year of visit or immediately preceding year. Exemption granted for 2 years from the date of arrival. Now this is very, very important point, guys. Please note this point in your register, or please highlight this in your PDF. I will be sharing this PDF with all of you. I will be sharing this PDF with all of you in the WhatsApp group. Please join the WhatsApp group. Test series, PDFs, everything will be shared to you in the WhatsApp group. Okay. Now, residents, teachers of SAARC countries are exempt from tax in India. So if you are a professor or a teacher who's a resident of Bangladesh, who's a resident of Bhutan, who's a resident of Nepal, who's a resident of Pakistan, who's a resident of Maldives, or who's a resident of Sri Lanka, if you're a resident of any of these countries and you're a teacher or professor and you come to India and the Indian government pays you certain allowances, they will be fully exempt. The condition is that your residency will be seen. So you should be resident of either of these countries, right? You should be resident of either of these countries, right? Your residency will be seen in the year of visit to India or the immediately preceding year. So guys, naturally, if you visit India in the current year, there's a possibility that you become Indian resident and you are no more resident of these states. If you stay in India for more than 182 days, the residential status chapter which we had done in our earlier session, guys, right? So if you are a resident in the current year of India, but you are a resident of these states in the last year, then also this exemption will be granted to you. So it says residency to be seen. Residency of what? Residency of these teachers and professor in these respective countries. This is the residency which is to be seen. So residency is to be seen in the year of visit, whenever the person is visiting India, or the immediately preceding year. And the exemption is granted for 2 years from the date of arrival. So guys, if person from SAARC countries visits India and stays in India for 2 years, then for the second year he will not become a resident of the country from where he is in, but he becomes resident of India. Even then the exemption will apply. So the exemption granted for 2 years from the date of arrival, whenever the person comes to India, till 2 years he will be allowed for this exemption, that whatever allowance he'll get for his teaching skills, for his tutorial skills, that will be taxable, that will be exempt from tax for next 2 years. For next 2 years that will be exempt from tax. Okay sir, got it? Next is the so-called difficult part. But if you are studying from my revision notes, nothing is difficult. Nothing is difficult. आसान है भाई, बहुत आसान है, बहुत आसान है, बहुत आसान. Partly taxable and partly exempt allowances. Allowances which are partly taxable and which are partly taxable. Allowances which are partly taxable and partly exempt. Allowances which are partly taxable, partly exempt. So guys, in these particular cases, exemptions depend on actual expenditure. whatever is your actual expenditure, that will be exempt, and whatever you save, that will be taxable in your hand. So in these cases, the exemption depends on actual expenditure, right? In these cases, exemption doesn't depend on actual expenditure, and the exemption is told to you by the Income Tax Act. So in this particular case, exemption will be told to you by the Income Tax Act. In this particular case, exemption will depend on your actual expenditure. So for example, I'll give you an example. So for transfer of your job from one state to another state, you are given an allowance of 1 lakh rupees to transfer all your stuff from one city to another city. This is known as transfer allowance. Now guys, you got allowance of 1 lakh rupees, right? Out of that 1 lakh rupees, you had spent only 80,000 rupees. 20,000 rupees is still with you. Then that 20,000 rupees will be taxable in your hands. So the exemption will be granted to the extent of actual expenditure. Whatever you had saved, whatever money you had saved in your pocket, that will be taxable in your hands. So exemption depends on the actual expenditure in these cases. Exemption depends on actual expenditure in these cases. So actual expenditure, when the exemption depends on actual expenditure, these are the cases: uniform allowance, professional development allowance, assistant or helper allowance, conveyance allowance. All these allowances will be exempt to the extent of actual expenditure. So the exemption is equal to amount which is spent. Okay, now guys, there's a very minute difference between assistant and servant. Okay, assistant and servant, please understand, there's a very minute difference between assistant and servant. Assistant is a person who's helping you in your professional pursuits. Servant is a person who's helping you in your home household chores. So only assistant or helper allowance is exempt up to expenditure, up to actual expenditure. If you get a servant for your home, that will be fully taxable. Nothing will be exempt, because for your personal expenditure, employer should not bear the burden. Employer should not bear the burden. If you are Indian resident in the current year but SARC resident in the previous year, then also allowances are exempt. Yes, Priya Jan, very good question. Very good question, Priya Jan. You understood the concept very well. If we are, please read Priya Jan's comment. I am highlighting that comment on the screen, guys. Please look at Priya Jan's comment. If we are an Indian citizen in the current year, but we were a SARC resident in the previous year, then also allowances are exempt in the current year. Answer is yes. Answer is yes. So you can be a SARC resident either in the current year or in the previous year. You will be allowed an exemption for next 2 years. That is very, very good interpretation. Priya Jan is absolutely right. Brilliant, Priya Jan. All right. Okay, let's move on. There is an exempt which doesn't depend on actual expenditure, but Income Tax Act will tell us what is the amount of exemption which is there. These are children education allowance, children hostel allowance, house rent allowance, truck driver allowance, transport allowance, tribal area allowance, discussed in the next slide. So now we'll be starting these allowances. Okay, guys. Okay, before starting these allowances, guys, these are a set of special allowances which are area specific allowances which are given to the employees who are working in some difficult areas, like hilly areas, mountains, snow-clad peaks. So all those areas are difficult areas where certain special allowances are given, and their exemption is given over here. Okay, yes sir, you have to remember these exemptions. You have to remember these allowances exemption very well. Number one, compensatory allowance, which is high altitude allowance. High altitude means when you are working at a very high altitude. Uncongenial climate. Uncongenial means not favorable. Either it's too much cold, too much warm, or too much humid. Uncongenial climate. Or snowbound. Snowbound means snow is there in that particular area. So if you get a compensatory allowance, which is for high altitude, uncongenial climate, or snowbound mountains in the areas of Arunachal Pradesh, Sikkim, UP, JNK, Manipur, Himachal Pradesh, then the exemption is 800 rupees per month. So suppose if you are getting 1000 rupees per month of allowance, the exemption will be up to the extent of 800 rupees per month. If you are working in Siachen area of Jammu and Kashmir, then the exemption is a very, very high amount. Siachen is a very, very difficult area to work in. You will get an exemption of 7000 rupees per month. If you are working in places located more than or equal to 1000 meters above the sea level, then you get an exemption of 300 per month. But yes, either of these conditions should be fulfilled. That either should be a high altitude area or a snowbound area or an area which has uncongenial environment. Similarly, guys, if you are working in border areas, so naturally, guys, these exemptions are specially meant for our army people, for our jawans, right, who are working on the borders. So border area, remote locality, difficult, disturbed areas. Andaman Nicobar, Narkodam, Lakshadweep, Minicoy Islands, north of demarcation line, Himachal Pradesh, Mizoram, J&K, UP, Sikkim, 1300 per month is the exemption amount. Continental shelf of India. So the continental shelf of India or executive economic zone. If you're working in these two areas, then the exemption will be 1100 per month. Then if you're working in Arunachal Pradesh, except those areas which are included above, you're working in Nagaland, you're working in South Andaman, that is Port Blair, or you are working in Lunglei district of Mizoram, okay, then you'll get an exemption of 1050. So now your question that will be popping up in your mind is, sir, do we have to remember all these limits? The answer is try to do it. Don't mug it up, don't spend a lot of time. But if you read this list, so I have a few lists over here, right? This is one of the lists, right? I have Tripura, Mizoram, and there are specified areas, right? Then I have another list, guys, which is again area specific list, which is this list, which includes tribal areas, high altitude areas, underground areas, compensatory field areas, compensatory modified field areas. I have this another list, guys. Compensatory high altitude areas, island, which is duty allowance, etc. So I have these two lists, guys. Just read these two lists thrice before your examination. Keep it with you, just read it thrice. No need to mug it up, no need to remember each and every state, but just read it thrice. If an obvious question or an easy question comes from this list, you'll be able to answer it, and that is the only fulfillment of our objective. Just read this list thrice, that's it. Don't try to mug it up, don't try spend a lot of time. Okay, sir, got it. Pankaj Kumar is telling us children education allowance exemption and children hostel allowance exemption. So Pankaj Kumar is on the next topic. We are on the previous topic. Pankaj Kumar is very, very fast. What to say? Some students are very, very fast, no? Yes. Okay, next is other allowances which are exempt to the extent of what Income Tax Act will tell us. So transport allowance, office to home, home to office, it is exempt up to the extent of 3200 per month. So suppose if the employer gives 6000 per month of allowance for transport, 3200 is exempt and the balance is taxable, 2800 is taxable. That is how taxable amount will be computed. So 3200 is exempt. In case of blind, deaf, dumb, handicap only, this exemption is there only in case of blind, dumb, deaf, handicap. The next is children education allowance. If children education allowance is there, if the employer gives employee in the name of children education some money, then what is the exempt amount? 100 per month per child, 2 children, irrespective of whether children are studying or not. Okay, even if children are not studying, then also this allowance will be exempt in the hands of all the employees. Then children hostel allowance, irrespective of actual expenditure, again, even if children are not in hostel, then also 300 rupees per month will be exempt in the hands of the employer, in the hands of the employee. Employer is giving, suppose employer is giving 1000 rupees per month of allowance. Out of that, 300 will be exempt, 700 will be taxable per child for a maximum of 2 childs. That is how the exemption will be calculated. Okay, sir. Let's move on. Oh, yes. Now we are going to start, guys, one of the most important allowances. Okay. The chances of this allowance coming in the examination is too high, way too high. Okay. House rent allowance. Okay. House rent allowance. If the employer gives the employee, any amount by way of allowance for meeting his rent expenditure, if the employer gives to his employee any kind of allowance for meeting his rental expenditure, then guys, any 2 children exemption can be taken where higher exemption is there. Yes, Jyotish. Any 2 children exemption can be taken. नहीं पंकज. So obviously जो actual amount received है उससे तो कम ही रहेगा. ये तो obvious सी बात है. ऐसा तो नहीं हो सकता एक्चुअल अमाउंट रिसीव्ड हो 3000 और तुम्हें हमें एग्जामिशन दे दें 3200 की. ऐसा तो नहीं हो सकता ना. वो तो है ही, ऑब्वियस सी बात है. तो पंकज, ओके. House rent allowance. House rent allowance means the allowance which is given to meet expenditure of house rent. Now, the employer will give some amount to the employee for paying his house rent. Income Tax Act will decide whether that amount is reasonable or not. Whatever Income Tax Act has decided, whatever amount is paid over and above that reasonable amount, that will be taxable as salary. So we will be computing the reasonable amount of house rent allowance which should have been given. That will be the exempt amount. So I've told you, in allowances, we'll always compute the exempt amount. So let's see how will we compute the exempt amount in case of HRA, human resource, house rent allowance. House rent allowance. So exemption to the extent of lower of the following. Lower of the following three numbers is the amount which is exempt. Okay. Number one, actual amount received. So whatever is the actual amount of HRA which is received, that will be the first criteria. Second is 40% or 50% of the salary. Salary is 40% or 50%. Okay, 40% in case of non-metro cities, 50% in case of metro cities. These are the metro cities where the house is situated. So depending upon where house is situated, in case house is situated in non-metro cities, then 40%. In case house is situated in metro cities, then 50% of salary. Now, what do you mean by salary? Guys, salary will only include three things: basic salary, DA, which is forming part of retirement benefit, and commission, which is calculated as percentage of turnover. No other allowance, no other perquisite, no other benefit is to be added in the definition of salary over here. Nothing else should be added. So 40% or 50% of the salary is allowed, is the second limit that we need to see. Then the third limit is rent, which is actually being paid by the employee, minus 10% of salary. Rent which is actually paid by the employee, the actual rent which is paid by the employee, minus 10% of salary. Again, salary definition will be the same as I had discussed in the earlier part. So we will compare all these three amounts, guys. We will compare all these three amounts. Whichever is lower out of all these three, that will be exempt HRA. That will be exempt from tax. That will be exempt HRA. Now let's see, exemption not available if assessee lives in his own house and does not pay any tax. So if assessee lives in his own house and he does not pay any rent, then that particular assessee is not eligible for any exemption because he's not paying any rent, guys. Okay. So if the assessee is not paying any rent, he's living in his own house and he's not paying any rent, then he is not eligible for a deduction. But yes, if an assessee is living in his own house and he's paying rent to his mother or his father, okay, and he proves that he is paying rent to his mother or father, then this exemption will be allowed. Okay, there's no harm, there is no restriction on paying rent to your parents. You can pay rent to your parents, that's okay. We will give you an exemption, that is not a problem at all. Yes, sir. Absolutely, Deepak Kumar. The child may be own, adopted, but not illegitimate, or grandchild. So grandchild is not eligible. Perfect. Deepak Kumar. All right. Next is truck drivers allowance. So guys, truck drivers are drivers who belong to transport companies, and they are given certain allowances, which are truck drivers allowance. Now, to what extent should they be taxable or exempt? So exemption to the extent of the minimum of the following: 10,000 per month or 70% of allowance received. 70% of allowance or 10,000 per month, that is the exemption which can be granted. But exemption granted to employees working in transport system. So obviously, guys, truck driver means he is working in some transport system, he is working in some company where transportation is an integral part of the company. Okay. Next, exemption is not granted if the employee is in receipt of daily allowance. So if the employee is receiving daily allowance as well as the employee is also receiving truck driver's allowance, then guys, truck driver allowance will not be exempted. It will be fully taxable because there's no difference between truck driver's allowance and daily allowance. They are one and the same thing. If you're getting daily allowance, then you will not be given any exemption over here. You please, avail the exemption of your daily allowance. That is the restriction. Next is, all right. So next is perquisites. What do you mean by perquisites? Okay, we'll just do one perquisite today, guys, which is rent-free accommodation, or we just have a background of these perquisites and we'll do a rent-free accommodation in our next class. Okay, what are perquisites? Perquisites are the benefits which are availed, which are not given in monetary form. They are availed in non-monetary form. That is known as perquisite, which means benefits are given to the employees. Benefits are given to the employees. For example, asset is given to the employee. So perquisites are of two types: taxable perquisites and exempt perquisites. Okay, taxable perquisites are rent-free accommodation, motor car, Sweat equity shares or ESOPs, we are going to discuss this topic very minutely in our class. So stay tuned for this topic. This is very important topic of your syllabus. Servant, perquisite of servant, electricity, water, gas, perquisite. Okay. Then free meals, interest free loan which is given, movable asset, credit card, club expenditure, etc. All these are taxable perquisites which are taxable. Then what are exempt perquisites? Exempt perquisites are tea, snacks, non-alcoholic, food is there, recreational facilities, goods manufactured by employer, sold to employees at a concessional rate, not free. Okay, goods. Then conveyance facility, it is a exempt perquisite. Training, exempt perquisite. Perks allowed by government to Indian citizen rendering services outside India like in embassy, etc. Exempt. Medical facility, exempt. Interest free loan up to 20,000, exempt. Rent free accommodation to certain employees, exempt. Accommodation in hotel or for 15 days, exempt. Computer laptop for office use, exempt. So all these perquisites are exempt. All these perquisites are taxable. So these are the two sets of perquisites which are there in our syllabus, guys. And yes, in the next session, we are going to deep dive into the perquisites. Okay. All right. So yes, guys, good morning and welcome to this session of salaries part 2. We had already completed the part 1 of our chapter in the last class. And this part will be dedicated to part 2. So guys, in the last class, we had covered our allowances portion, right? Allowances means the monetary benefit which is given to an employee, the money which is given to an employee for meeting certain specific expenditure, that is known as allowance. Allowance is always given in monetary form to the employees, which again is taxable, subject to the exemptions which are made by the Income Tax Act. Apart from the exemptions which are made by Income Tax Act, the entire amount of allowance is taxable in hands of the employee. So allowance is a taxable portion of salary chapter. And the second portion that we are going to discuss today is perquisites. Now, what do you mean by perquisites? Perquisite means something which is not given in monetary form, but it is given in form of benefits, which means it is given in form of some benefit, like you give to your employee a car, you give to your employee some accommodation to live free of cost, you're not charging anything from that particular employee. You give some servant to the employee for his personal benefit. All these things are known as perquisites. And again, perquisites are taxable. Income Tax Act has shown us the way in which perquisites are taxable. Perquisites are taxable according to the rules and regulations, according to the calculations which are given in the Income Tax Act. Perquisites are taxable. The major difference between perquisite and allowance, if I were to point it out, is that allowances are delivered in form of money, in form of hard cash, right? So allowances are delivered in form of cash, in form of money, and perquisites are delivered in form of benefits. Benefits like, you know, the car is being extended to the employee, or a house is being extended to the employee. So the perquisite is being extended in form of benefits, and allowances are extended in form of cash, right? Second difference which is there between perquisite and allowances is that, guys, in case of allowances, exemptions are computed, which means the Income Tax Act would specify how much of a particular allowance is exempt, and the remaining amount will be taxable. So suppose if a total allowance is, say, given to you for 20,000 rupees, then the exempt allowance will be, the calculation of exempt allowance will be given in the Income Tax Act. Suppose the exempt amount is 5,000 rupees. So out of 20,000 rupees of total allowance which is given to the employee, 5,000 rupees is exempt. What is the taxable amount of allowance? The taxable amount of allowance is 15,000 rupees. That is the way we compute the taxable allowances. Now, coming on to perquisites, guys, in case of perquisites, we do not calculate the exempt part of a perquisite, but we directly calculate the taxable part of perquisite. Perquisites which are taxable, they are to be computed, and Income Tax Act gives a specific formula for the perquisite to be taxable and what amount of perquisite will be taxable. Directly we compute the taxable part of perquisite. So that is the difference between perquisite and allowance. In allowances, we compute the exempted part, the part which is exempt. And in case of perquisites, we calculate the amount which is taxable. So taxable amount is calculated in case of perquisites. However, in case of exempt allowances, we calculate the exempt portion. So yes, let's start the chapter, the topic. The name of the topic is perquisites. And the first perquisite which we are going to deal with today is rent-free accommodation. The first perquisite which we are going to deal with is rent-free accommodation. It is a house which is given to the employee free of cost, nothing is charged, or even if some bare amount of rent is charged, it is much below what is eligible to be charged from the employee. So perquisites, the first perquisite is rent-free accommodation. Rent-free accommodation is given to the employees, is given to the people who are wanting to take our home from the employer. So rent-free accommodation generally employer gives to its employees, and not all employees, guys. Employees who are of a certain designation, of a certain level, those employees are given this perquisite, which is known as rent-free accommodation. So this is rent-free accommodation. We are going to calculate the amount of rent-free accommodation. How will we calculate the amount of rent-free accommodation? That is what we are going to calculate now. And the best part is that, guys, in this particular case, there's no amount, there's no monetary value which is given to the employees. It is directly the benefit which is given to the employees. And the benefit which is given to the employees is in form of perquisite, the benefit itself, which is the rent-free accommodation which is given to the employee. So rent-free accommodation, the perquisite which is given to the employee. Rent-free accommodation means that we are not charging any rent from the employee. Employee is given a house to live in. Let's start the calculation. So first of all, there is government employee. The rules are different for government employees. Rules are different from government employees who are on deputation to specific undertakings, and rules are different for other employees. So we are dividing our discussion into three parts. Rule of rent-free accommodation for government employee, rule for rent-free accommodation for government employee who is on deputation to any undertaking controlled by government, and rules for rent-free accommodation for other employees. Other employees means the employees which are belonging to the private sector, the employees which are working in the private sector. For them, there are third set of rules. So first set of rules refer to the rent-free accommodation which is given to government employees. And guys, you must have heard that government employee gets a big house, where he would stay, and his entire family will stay in that particular house. And that house is given to the government employee free of rent. There's no rent which is charged. So yes, this rent-free accommodation which is given to a government employee will definitely be taxable in hands of the government employee. Whether the employee is a central employee or a state government employee, both are eligible to be taxed in the same manner. Secondly, those employees which are working in undertakings controlled by government or any military persons will also be categorized as the employees which are eligible for rent-free accommodation under the government sector. Okay, so government sector includes four things: central government employees, state government employees, employees who work under the undertaking controlled by the government, employees who work under the undertaking controlled by the government. So if there are PSUs, the the Navratnas, the Maharatnas, if the employees working over there under the undertaking which is controlled by government, that will also be categorized as government employee. Plus any military persons who are there. So the persons who are working in military, those persons will also be eligible for this particular calculation of rent-free accommodation. So these four things are categorized as government employees. Number one, central government employee. Number two, state government employee. Number three, employees who are employed under the undertaking controlled by the government. And number four, military persons who are working in military, persons who are soldiers in army. They are also categorized as government employees. Now guys, for all of these employees, the valuation of taxable part of perquisite is very simple. It is the license fees determined by the government itself. So government has its own bylaws, government has its own laws. According to those laws, government will determine the license fee, whichever license fee is there, and government is going to determine what amount of perquisite should be taxable. Now guys, there's a big house. Okay, now how to value what is the rent of that house, or how to value the taxable value of perquisite of that particular house, is determined by the license fee, which is determined by government. So license fee will be determined by government, and that is the value of perquisite or for in case of government employees. Now we come on to government employees who are under deputation to any undertaking controlled by government. Guys, sometimes what happens is that a person belongs to government of India. He's an employee of government of India, but he is deputed to. Deputed means what? He is required to work with a PSU as a nominee of government. He is required to work with a PSU as a nominee of government. Now, this particular second category is for those government employees who are working under deputation in a PSU. Deputation is a different thing, and if you are on rolls of PSU, then you fall under this category. But if you are not under rolls of PSU, you are a government servant, but you are working as a deputy, as a deputation role under under the realms of Government of India. You are working in a deputation in which organization? PSU, public sector undertaking. Then you are eligible to value your perquisite in the following manner. Third is private employees. Other employees means specifically private employees. Private employees are required to value their perquisite in this particular way. So now we are going to see the second way first. Okay, the second way. Okay, one important thing that government employees, two things are excluded from definition of government employees: excluding employees of local authority or foreign government. So we will exclude the employees of local authority. Local authority employees are not included in government employees, and any kind of foreign government employees, government is not of India, foreign government employee who are working in India, they are also excluded from government employee definition. So they will not be considered as government employees. They will be clubbed under this third category, which is the other employees head. These are the three categories of employees which we are going to consider in perquisite of rent-free accommodation and how to calculate that perquisite. Now, coming on to how to calculate the perquisite in case of government employees who are on deputation to any undertaking controlled by the government. If any undertaking is controlled by the government and any government employee is on a deputation in that particular undertaking, how will we value the perquisite value in that particular case? So guys, this is the table which shows how will we value this particular perquisite. Population, it is on the basis of population. So if the city where accommodation is provided, its population is more than 25 lakh rupees, then we will calculate the taxable value of perquisite as 15% of salary. Then if the population is 10 lakh to 25 lakh rupees of that particular state in which accommodation is provided, okay, this is the population you have to see of the area of the state where the population is where the accommodation is provided. So 10 to 25 lakh rupees, 10 to 25 lakh population, this is the 10 to 25 lakh population bracket. 10% of the salary is the taxable value of perquisite, and below 10 lakh population, then the taxable value of perquisite should be 7.5% of salary. So 15%, 10% and 7.5% of salary is the benchmark which will be used as taxable value of perquisite. Guys, again, it is just an estimate. It is just an estimate. There is no concrete way, or there is no hard and fast formula which can be applied to tell you that what is accurately the value of a particular perquisite. There is no hard and fast formula like that. It is just an estimate. So all these numbers are just an estimate of computing the taxable value of perquisite. They are just an estimate. So on an estimated basis, we are calculating these value of perquisite, 15%. And 7.5%. This is the taxable value of perquisite which is given under the Income Tax Act. Again, a mechanism to compute it. But if you ask me, sir, will it give us an accurate and absolute accurate figure? I'm not too sure about that, whether it gives an absolute accurate figure or not. But as per the Income Tax Act, the taxable value of perquisite will be computed using these three benchmark, using these three formulas. Okay, and last, of course, but not at all the least, and the most popularly used formula, the most highly used formula of computing rent-free accommodation in case of other employees, that is the private employees which are there. In case of private employees, the calculation of rent-free accommodation is computed as under. Let's see what is the value of rent-free accommodation in case of private employees, or so to say other employees. So in case of private employees or the other employees, if the accommodation is owned by the employer, then we have a different set of formula for it. And if the accommodation is hired by employer, then we have a separate set of formula for it. Okay. So what is difference between accommodation owned by employer and accommodation hired by employer? So guys, employer might also not own that particular house that it is giving to its employees. The employer might hire it, might take it on rent and then give it to employees, and the rent is being borne by the employer. Possibility. So there are two possibilities. Accommodation is hired by the employer. There are two possibilities. Possibility number one, accommodation is hired by the employer. Possibility number two, accommodation is owned by the employer. Employer is the owner of that particular accommodation. That is the second possibility. First possibility is accommodation is hired by the employer. These are the two possibilities which are there. Okay. Now, if the accommodation is owned by the employer, if the employer owns the accommodation, if the accommodation is owned by the employer, it is employer's own accommodation which is being granted to the employee, then the perquisite value will be determined as per the same formula, as per this table which we had just studied. That if the accommodation is provided in an area where the population is more than 25 lakhs, then 15% of salary is the taxable perquisite. If the population of that area is 10 to 25 lakhs, then 10% of salary is the taxable perquisite. If the population is less than 10 lakhs, then 7.5% of the salary is the taxable value of perquisite. Using this formula, we calculate the accommodation value which is owned by the employer. So if the accommodation is owned by the employer, then this is the formula which is to be used. But if the accommodation is hired by the employer, which means that employer is actually paying rent for that particular property which it gives to its employees, right? So accommodation is hired by the employer. If the accommodation is hired by the employer, then perquisite is lower of the following: rent paid by the employer, the rent which is actually paid by the employer, or 15% of salary, whichever is lower. Whichever is lower is the taxable value of perquisite if the accommodation is hired by the employer. Naturally, guys, if the premises is hired by the employer, then obviously employer would be paying some rent to a third party for providing that rent-free accommodation to its employees, right? So this is that rent which is paid by the employer, or 15% of salary, whichever is lower. 15% of salary, whichever is lower. That is the value of perquisite which is there. Okay, sir, got it? Now some basic rules, guys. Some basic rules about this particular perquisite. Okay, and the basic rules are that the perquisite value of furnished rent-free accommodation. So the formulas which we had just now studied, those formulas are for unfurnished home. If the unfurnished home is given to the employees, then the formulas are to be used. But if the home is furnished home, if it is a fully furnished home, then the value of perquisite will be perquisite value of unfurnished home, which is given as per the formulas which are given above. So perquisite value of unfurnished rent-free accommodation, which are given over here, that value which we have computed, plus perquisite value of furniture. We'll add perquisite value of furniture to this rent-free accommodation to get the full value of perquisite. So perquisite of furnished rent-free accommodation is equal to perquisite value of unfurnished rent-free accommodation plus perquisite value of the furniture which is given along with the rent-free accommodation. That is how we'll compute the perquisite value of furnished accommodation. If the accommodation is furnished and sir employer, then 10% of the original cost. If the furniture is hired by the employer, then rent which is actually paid for this particular furniture is the value of perquisite which is to be added to the salary of the employee. That is how furniture valuation, perquisite of furniture valuation is to be calculated, is to be undertaken. That is how. Next is, what is the definition of salary? Definition of salary is basic dearness allowance, retirement benefits, any bonus is to be added, commission plus fees is to be added, taxable allowances are to be added, any monetary payment, so allowances are to be added, any monetary payment is to be added, termination benefits are to be added like VRS, pension, leave encashment, etc. So guys, apart from perquisites, everything else should be added to compute the salary in this particular rent-free accommodation case, in the perquisite of rent-free accommodation. Then one important aspect of rent-free accommodation is, guys, sometimes what happens is, the employees moving from one state to another state. So employees being transferred from, say, Mumbai branch to Delhi branch. In Mumbai, the employee had a rent-free accommodation, and in Delhi also he is being given a rent-free accommodation. In Mumbai, he had a rent-free accommodation, and Delhi also he's being given a rent-free accommodation. So there can be a period of overlap. Overlap means there can be a period when the employee is having a rent-free accommodation in two states. First in Delhi, second in Mumbai. In both the states, rent-free accommodation is there on a parallel basis, on an equal basis. This is very much possible. So this is a possibility. So this possibility has been taken into consideration by the Income Tax Act. Now the question is whether, sir, during that intervening period, when we have rent-free accommodation in both Delhi and Bombay, will we be subject to double taxation because two rent-free accommodations are there? So guys, Income Tax Act says that if the overlap or if the double perquisite is there for 90 days or more, if the double perquisite is there for if the double perquisite, if the perquisite at both the places are there for 90 days or less, then it is exempt. Up till 90 days it is exempt. So exemption for 90 days for two houses. So if two houses are there for 90 days, we are going to calculate the rent-free accommodation of only one house, whichever has got a lesser rent-free accommodation value. So for 90 days we'll have the lesser value of house, whichever is the value perquisite of whichever house is less, we'll have that particular perquisite for 90 days. But if you have both the houses under your possession for more than 90 days, then guys, for 90 days, perquisite value which is lower of both the houses, that is the perquisite value. But if you have both the houses for a period exceeding 90 days, now this is wrong. There can be an overlap of say maximum 90 days, which is 3 months. 3 months you can have both the houses. But if you extend your double houses, two rent-free accommodations for beyond 90 days, then aggregate of perquisite value of both the houses should be taken into consideration while calculating the perquisite. The perquisite value will be the perquisite value of house 1 plus the perquisite value of house 2 taken together. That will be the total value of perquisite of rent-free accommodation. Yes, we are going to charge double rent-free accommodation from you because you are being given two houses in different states. We are going to charge double the value of perquisite. Obviously, guys, since you have two houses, you have two rent-free accommodations, and the time period of 90 days in case of transfer has expired, then guys, we are going to charge both of them as rent-free accommodation. You'll have to pay perquisite on both the rent-free accommodations. That is the law. That is the rule. Okay, so yes, this was one of the most important perquisites of your syllabus, guys, rent-free accommodation. And yes, examiners favorite perquisite, let me tell you. So in the examination, you will find this perquisite quite often. It has been repeated quite often in the examination. Now, what if the accommodation is given in a hotel? What if accommodation is given in a hotel? It is not given in a house which is rented or owned by the employer. It is not given in a house. It is given in a hotel. Then what happens if the accommodation is given in a hotel? Then guys, this is a perquisite for both government and non-government employees. This perquisite is eligible for both government and non-government employees. Accommodation which is given in a hotel. Value of perquisite should be lower of the following. So value of perquisite should be lower of the following: 24% of salary or the actual charges paid to the hotel by the employer. So employer is paying some amount to the hotel, right? So we are going to compute the 25% of salary value or the actual amount of charges which is paid to the hotel. Lower of the following should be the taxable value of perquisite. This is only and only in a case where accommodation is provided in a hotel. Accommodation is provided in a hotel. So where accommodation is provided in a hotel, then the value of perquisite should be lower of 24% of salary or actual charges paid to the hotel, whichever is lower. Nothing is taxable if accommodation is provided 15 days on transfer of employee from one place to another. So if the transfer happens only for the hotel is provided only for 15 days, and that too in case of transfer of employees, where the employee is getting transferred from one place to another place, okay, for that particular period. Ankit Shukla is saying that if the allowance are in form of kind, how should we add it? So Ankit Shukla, the answer is very clear that if it is in form of kind, then the Income Tax Act is telling you how to compute the monetary value of that kind benefit. And this is what perquisite is all about. Perquisites are always given in kind. So Income Tax Act will tell you what is the value, monetary value of that perquisite which is given in kind. That is what we are discussing in the class right now, perquisites. They are not given in cash, they are given in kind. So Income Tax Act will tell us what is their value in monetary terms. That is the answer, Ankit Shukla. Jyotish Shah says, sir, we will calculate the days wise or month wise in case of two houses. Days wise is the ideal way. However, sometimes, the question can actually, for ease of computation, can also calculated month wise. But days, counting of days should be actually the right way. Okay, sir. Then nothing is taxable for 15 days. For 15 days, in case of transfer, nothing will be taxable. Both the rent-free accommodation will be, the rent-free accommodation which is given in hotel will be tax-free for 15 days. Salary includes all the elements as included while calculating the RFA. So salary definition will be the same as we had seen in rent-free accommodation. All right, now we move on to one of the very important perquisites of our syllabus, guys. And yes, this perquisite is actually very, very important perquisite. This perquisite is the perquisite which is usually given to the higher segment of the company, which is the managers, the general manager, the senior managers, the senior managerial roles, the supervisors who are sitting at a considerably high level. This particular perquisite is given to them. So this perquisite is known as sweat equity shares or ESOPs, employee stock option plan. Employees stock option plan or sweat equity shares. This is known as ESOP, which is given to employees, and yes, it is taxable as salary in the hands of the employees. Now, before we come on to the taxable portion, to computing the taxable portion of perquisite, let me let me just explain what do you mean by ESOP. What is this sweat equity share? What is the meaning of this word ESOP? Now let us first examine this. So ESOP life cycle. ESOP life cycle. So ESOP is shares of the company which are granted to the employees at a very, very minimal rate at a discounted price than the market. So I'll give you an example. Suppose a company's shares are trading in market at 120 rupees. Employee will offer those shares to the employees at 100 rupees. That is known as ESOP. That is known as ESOP. But yes, in return of getting this benefit, the employee is expected to not to terminate his service for a stipulated time period. He will be signing a bond that he will be staying with the company for a stipulated period. There are some restrictions which are imposed on the employee if they are opting for ESOPs. Of course, we don't want employee to have a short-term capital gain and fly away with our ESOPs and leave the company. We want employee to work for the company, for the betterment of the company, for a longer period of time. Since we have invested in that particular employee, since we are giving our ESOPs at a concessional rate to that employee, we will expect that employee to work for the company for a longer period of time, little longer period of time. We will expect the employee to work for the company. So yes, this is the life cycle of an ESOP. How does ESOP function? How does ESOP evolve? This is the lifetime, the life cycle. Let us see. So first step is that the ESOPs are granted to the employee. ESOPs grant means an option is given to the employee. An option is given to the employee to take ESOP of the company. It is an option. It is not an obligation. It is a right. Right means it is a right. ESOP means it's a right, which means the employee can also choose to reject the offer. So why would an employee reject the offer, such a lucrative offer, a thing which is worth 120, employees getting 400? Why would employee leave this offer? Guys, the reason can be many for this particular leaving. Number one, employee doesn't have money to pay to the company, even to the extent of 100 rupees. Employee is short of money, because ultimately 100 rupees is to be paid to the company. Employee short of money. Employee doesn't want to invest in that particular company. Reason number two, employee knows that he is not going to work with the company for a longer duration, for a longer period of time. Employee knows that he's not going to work for the company for a longer period of time. Then also he may reject the offer which is given to him by the company. So this can be the second reason. Similarly, guys, there can be many reasons why the why the employee choose not to take sweat equity shares. There can be several reasons. And yes, employee is free to choose to not to invest in ESOPs. But every employee who is eligible to take the ESOPs is first granted the right to choose. Employee has to choose. Then he is given some time to think. Some time to think. That is known as vesting period. Vesting period. He is given 1 year time to think. You think, please, you think properly, and then you tell us whether you want to purchase these shares of the company or not. So this is known as the vesting period. Period when the employee is given the option to think whether he wants to choose to take the shares or not. This is known as vesting period. Vesting period is usually of 1 year, 2 years of time. Then comes the exercise date, the date when the employee has to finally decide whether he wants to take the shares or whether he doesn't want to take the share. That is known as exercise period. That is known as exercise period. So guys, on the grant date, employee is given a right to buy the shares, suppose at 100 rupees. The shares were worth 120 rupees at that point in time. At that point in time, the shares were worth 120 rupees. So the shares would be available to the employees at 100 rupees on the exercise date. So on the exercise date, employee will be granted the shares worth rupees 120 at 100 rupees. So guys, now tell me something. The shares were worth 120 on the grant date. The shares were worth 120 on the grant date, and the shares were offered to the employee at 100 rupees. Now suppose till exercise date, the shares value increases by 20 further rupees, and the value of the share is 140 rupees on the exercise date. On the exercise date, the shares are worth 140 rupees. But still, guys, on the exercise date, the share will be available at 100 rupees to the employee. What is the amount of gain which employee has from exercising these shares? If he exercises these shares, I want the answer in the chat box. Please write the answer in the chat box. If the shares are worth 140 rupees on the exercise date and the employee is required to pay 100 rupees, which according to which the right was granted, then how much benefit would the employee have taken by buying the share at 100 rupees? The share is worth 140 rupees. What is the total amount of benefit which accrues to the employee? Yes, very good. Pankaj says 40. Ravi says 40. Muhammad Azam says 40. Miraki Kartike says 40. Jyotish says 40. Ravi Gupta, Vivek Sharma, Kirti Batra, Abhishek Kumar, Aditi, SPD, Yashika, everyone says 40. Perfect answer, guys. Perfect answer. Perfect answer. The benefit which employee gets is worth rupees 40. Now, as per the Income Tax Act, this 40 rupees is taxable as salary in hands of the employee. This is the perquisite value which is taxable in hands of the employee. This is the perquisite which is taxable in hands of the employee, and the perquisite value is 40 rupees. 40 rupees is taxable in hands of the employee as salary. 40 rupees is taxable in hands of the employee as salary. So this 40 rupees is the difference between the market value of the share as on the exercise date minus the value which is paid by the employee to the employer. This is the value of perquisite which is taxable. Okay, sir, got it? So what does it say? It says fair market value on exercise date. Value of perquisite is equal to, so difference between grant of option and exercise date. This is the vesting period, guys. This is the vesting period. Grant of option, exercise date, and sale of shares. This is something different. This we are going to discuss in capital gains chapter. Okay, this is not salary chapter. This we are going to discuss in capital gains chapter. This is very different. What I am referring to is the grant of option which is granted till the time when the option is exercised. So difference between grant date and exercise date. What is the difference between grant date and exercise date? The difference will be the fair market value, and that fair market value is taxable as perquisite value. The fair market value will be taxable as perquisite value. Now, what if FMV is less than value of grant of option? Then Jyotish Raj, no employee will take that particular option. In that case, no employee will take that particular option. Employee will ignore that option. Employee will not take that option in that particular case. That is the correct answer. Okay, sir. Yes, there can be a situation FMV is less and grant was more. So during the time when time passage, when time passed, the FMV had fallen. This can be a case, very practical case. Okay, sir. Next is ESOPs are granted in exchange of providing know-how by the employees. So employees providing know-how, employee is providing his technical skills, his intellectual property skills. That is what employee is providing to the employer is providing to the employee, and in exchange of those skills, ESOPs are granted to the employee. So ESOPs are granted to the employee against what skills? Against skills of providing know-how, intellectual property, the work that employee will be doing in the business. That particular know-how, that particular benefit is given to the employee. So against that benefit, the ESOPs are granted. In case they are granted against any other consideration, so if the employer is actually, purchasing property of the employee, and against that property it is offering its shares, then it is not taxable perquisite. Okay. So if the ESOPs are granted against any other consideration like acquisition of employees' property, it will not be taxable as perquisite. It may be taxable. It may be taxed as capital gain. So if these shares, if these sweat equity shares, if these ESOPs are offered against anything apart from the intellectual property, then guys, it is taxable as capital gains and not as perquisites. It is not taxable as perquisites. It is taxable as capital gains. So that is out of purview of salary. And guys, there's one more stage to these ESOPs. Subsequently, the employee might sell off these shares to a third party. In that case, there will be capital gains which will accrue in this particular case. And those capital gains we'll be dealing with in our chapter of capital gains, not in our chapter of salary. Okay, sir, got it? Let's move on to the next perquisite, which is the next perquisite. And yes, next perquisite is motor car along with chauffeur's salary. So what is this chauffeur? What do you mean by chauffeur? Chauffeur means driver. Chauffeur means driver. This is the spelling of chauffeur. And in simple words, chauffeur means driver. So, sometimes car is given to the employee free of cost. Employee is using that particular car. Okay. Free of cost, he is using that car. And driver is also given to the employee. And the driver's salary is also paid by the company. Driver's salary is also paid by the employer. So in case motor car and driver is provided to the employee, then what will be the taxable amount of perquisite? That is what we are going to study now. Now, motor car is granted to the employee. Employee might use it for official purpose. Employee might use it for personal purpose. Employee might use it for official plus personal purpose. There can be three situations. There can be three uses of this particular motor car plus chauffeur's salary plus driver. Employee can use it for official purpose. He can use it for meeting the clients, meeting the debtors, meeting the creditors, or doing some work of office. He can do he can make use of this particular motor car for official purpose. He can make use of the motor car for personal purpose. Now this is very, very dangerous. Okay, he can make use of the car for personal purpose. He can make use of the car for official plus purpose. Personal purpose, he might use it partly for personal purpose, partly for official purpose. This can also be the case. So Jyotish says, in case of accommodation in hotel for more than 15 days, whole 15 days, or we exempt first 15. We exempt first 15 days, Jyotish. We exempt first 15 days. Okay. Official use, there will be no perquisite. In case of official use, there will be no perquisite because the entire income is taxable as perquisite. In case of purely official use, in case of 100% official use, there will be no perquisite at all. In case of personal use, if the motor car is being used for personal purposes, then guys, this particular perquisite will be taxable in hands of the employee. If the employee is using only for official purpose, only for work of the office, he is taking this car, then no perquisite at all. Perquisite will be taxable if the taxi or the motor car is being used for personal use, then perquisite will be taxable. How will the perquisite will be taxable? So if the car is owned by the employer, there may be two situations. A, car is owned by the employer. Number two, car is owned by employee. So if car is owned by the employee, then it's employee's headache. Why would it be taxable as perquisite? Guys, even if car is owned by the employee, then there can be a situation where maintenance of the car, petrol, diesel expenses of the car are being met by the employer. Even if the car is owned by the employee, then also the maintenance charges of the car or the diesel charges, petrol charges, the coolant charges, or the other maintenance running charges are undertaken by the employer. This can be a situation. So under that situation, it will be a perquisite. So yes, ownership of the car is with the employee, but its running expenditure is being undertaken by the employer. In that case, there will be a perquisite. And in case car is owned by the employer, then guys, entire amount of depreciation, which actually the employer should not be having, because the employer is not using it for his own purpose, employer is using it for personal purpose of the employee, right? Then entire amount of depreciation and entire amount of maintenance charges should be the taxable perquisite in hands of employees. Let's read. When it is maintained by the employee, then perquisite value is depreciation. because maintenance is done by employee, it is not done by employer. So the value of perquisite is depreciation, only depreciation is the value of perquisite. But when it is maintained by employer, if the employer maintains the car, it is owned by the employer and also maintained by the employer, then depreciation plus maintenance charges is the value of perquisite. Please understand this difference, okay? If the maintenance is done by employee, if the employee is doing maintenance, if the headache of employee maintenance is with the employee, then guys, the perquisite is with respect to depreciation only. Depreciation is the value which is actually borne by the employer, but its benefit is being taken by the employee. So it is depreciation is the value of perquisite. But in case it is maintained by the employer, if the employer is maintaining it, then depreciation as well as maintenance charges both are being incurred by the employer for the benefit of the employee. Then the perquisite value is depreciation plus maintenance charges. Second, car is owned by the employee. If the car is owned by the employee, if the employee is the owner of the car is owned by the employee, then it is maintained by employee. If it is maintained by employee, then perquisite is nil, because ownership is also with the employee, maintenance is also with the employee, then the perquisite value is nil. We will not charge any perquisite value, okay, because the expense is entirely borne by employee and he's personally using it. What is there to be taxable as perquisite? There's nothing which is taxable as perquisite, because it is owned by the employee. Employee has purchased it. Employee is also bearing maintenance cost of it. So we have no problems. But we have a problem where the car is owned by the employee, but it is maintained by the employer. The maintenance charges are being paid by the employer. In that case, we have a problem. When the car is owned by the employee, but it is maintained by the employer, we have a problem over there, because the maintenance charges which are paid by the employer to the for maintenance of the car are actually used for personal use of the employee. It is used for the personal use of the employee. Therefore, we are definitely going to charge perquisite value of maintenance charges, including chauffeur's salary. So chauffeur's salary is included in maintenance charges. So guys, simple as it is. What is the simple technique? The simple technique is that, guys, if the car is owned by the employer, right, then we have to see depreciation is definitely borne by the employer, because whosoever is the owner, he bears the depreciation. So depreciation is obviously owned by the employer. Now we have to see whether maintenance charges are being paid by the employer or the employee. If the maintenance charges are being paid by the employer, then the perquisite value will be depreciation plus maintenance charges. But if maintenance charges are being borne by the employee itself, then we have no problems in it. We have absolutely no problem in it. If the charges of maintenance charges are being borne by employee, then the perquisite value will only be the depreciation, because depreciation is claimed by the owner, who is the employer. However, if the car is owned by the employee and maintenance is also done by the employee, then perquisite value is nil. We will not charge any perquisite, okay? But if the maintenance is done by employer, then maintenance charges will be the value of perquisite. Maintenance charges will be the value of perquisite. That is the difference in calculation of perquisite. Okay, sir, got it? Okay, and the next is the complex one, guys, the complex one. If there is a mixed use, then this is actually a little dicey. Can he charge depreciation under 32? Yes, he can charge depreciation under 32. Absolutely, yes. Because the car is being used for official purpose, then he can charge depreciation under section 32. Okay. Official plus personal use. If the car is being used for official plus personal use, we'll refer the next slide to calculate this particular perquisite. But before that, let us read some notes. The note says, recovery, if any, from the employee must be reduced from value of perquisite. So if anything is being recovered from the employee regarding this particular perquisite, if anything is being recovered from the employee regarding this perquisite, that will be reduced from the value of perquisite. Whatever is recovered from the employee against this perquisite, that will be reduced from value of perquisite. Vehicle provided for journey from home to office is not taxable perquisite. So if the transportation facility is provided from home to office, office to home, okay, to and fro from office to home, then it is not regarded as a taxable perquisite. Taxable perquisite of a motor car will only be eligible when the car is being used by the employee for his personal purpose, okay, not for commuting from work to home. That is not a chargeable perquisite, because that is purely official use. That is not a personal use. That is purely official use. So no perquisite will be taxable in that particular case. Okay, one more important thing, guys. One more very important thing. One more important point that I need to discuss over here. Guys, if the car is owned by the employer, if the car is owned by the employer, if employer is owning the car, then it is taxable in hands of employee only when the employee is a specified employee. Only if the employee is a specified employee, then only this perquisite is taxable in hands of the employee. We'll discuss in our subsequent slide what do you mean by specified employee. Okay, sir. Now, guys, first of all, we are going to discuss, I've told you, the complex part of it. Complex means case where motor car is used for official plus personal purpose. So car is used for both official and personal purpose. That is what the perquisite is all about, and we need to calculate the perquisite in this way. Motor car used for official plus personal purpose. When motor car is used for official and personal purpose, both of them, then this is the value of perquisite. Number one, car is owned by the employer. Again, when car is maintained by the employer or the car is maintained by the employee, we bifurcate into two parts. Now, guys, let me tell you one very frank thing, guys. In case we were valuing the perquisite when it was entirely used for personal purposes, then all the expenditure which was incurred for maintaining or using that car was the total amount of perquisite. Okay. Now, in this particular case, when half of the portion is for official use, half of the portion is of personal use, then out of the total value of perquisite, only a particular portion is taxable as perquisite. Only a particular portion is taxable as perquisite. So in this particular rule, we are going to study, we are going to see what is that portion, what is that proportion of the value of perquisite which is taxable as perquisite. So we are going to split, basically we are going to split the expenditure into two parts: official use, personal use. Personal use we are going to tax as salary. Official use we are not going to tax as salary. That is the bifurcation which we are going to do in this particular part, right? Okay, guys. So when car is owned by the employer, if the car is owned by the employer, then undoubtedly, guys, depreciation is first thing that will be charged as a perquisite in hands of the employee. If the maintenance is by the employer, if the maintenance is also by the employer, then depreciation plus maintenance, both of them will be taxable in hands of the employer. However, if maintenance is done by the employee, then only depreciation is taxable in hands of the employee. Now, the question is, so what will be the value of that depreciation and maintenance? We know the total value, sir. We know the total value of depreciation. We know the total value of maintenance. How to split it between personal use and official use? How to split it? Guys, no need to split it. Income Tax Act has given you specific numbers to tax. Simple. Income tax has given you taxable perquisites. Simple numbers to tax. Okay. So if your car is less than or equal to 1.6 cc car, cubic capacity of the car is 1.6 cc, then perquisite value is 2400 per month, 2400 per month. If your cubic capacity is more than 1.6, then your perquisite value is rupees 1800 per month. That is the difference. The cubic value is rupees 2400 per month. The cubic value is 1800 per month. If the car is owned by the employer and maintained by the employer. Car is owned by the employer and maintained by the employer. But if the car is owned by the employer and it is maintained by employee, which means only depreciation is charged to tax, then if the car is less than 1.6 cc, then perquisite value is 900 per month. If the car is more than 1.6 cc, then perquisite value is 600 per month. They are the perquisite value of the cars which are there. That is how, if the maintenance is done by employee, then the maintenance, the chargeability is as under perquisite value is 900 per month and 600 per month respectively for a smaller car or a larger car. That is how perquisite will be valued. Okay, sir, got it? Then second case, when the car is owned by the employee. So no question of depreciation now. Depreciation is being borne by the employee. So we are not going to add depreciation to the perquisite value, only maintenance. If the maintenance is done by employer, then only we are going to tax. If the maintenance is done by employee, we are not going to tax. Perquisite value is nil. If the maintenance is done by the employee, the perquisite value is nil. If the maintenance is done by the employer, then the perquisite value is actual expense minus 2400 or 1800, depending upon the size of the car, whether it is 1.6 cc or not. We are going to reduce the value over here. So whatever is the actual expense of the employer, since it is maintained by the employer, whatever is the actual expense which is incurred by the employer in maintaining this particular car, minus 2400 or 1800 depending upon the size of the car, whether the car is 1.6 cc or whether the car is for lesser than 1.6 cc. Depending upon that, the perquisite value will be determined, depending upon whether it is less than equal to 1.6 cc or not. Then the next is specified employees. Now, I told you guys in the early lecture as well that whenever the car is owned by the employer, whenever the car is owned by the employer, when the owner of the car is the employer, whenever the car is owned by the employer, guys, in that case, the taxable perquisite is taxed only in hands of specified employees. Now, who are these specified employees? Specified employees are director employees, employees who are directors of the company, employees holding substantial interest in the company, employees who have substantial interest in the company, like 20% or more shareholding or profit sharing or decision making powers in the company, or aggregate salaries more than 50,000 rupees per annum, whose aggregate salary is more than 50,000 rupees per annum. That particular employee is a specified employee. Now, guys, obviously 50,000 rupees per annum is a bare minimum salary of any employee. Any employee will be categorized under this particular category. There'll be very rare employees who will not be categorized under this particular category. So any kind of employees will be categorized under this particular category. So the amount of salary is 50,000 rupees per annum. Salary is 50,000 rupees per annum. Okay, sir, got it. Next is, in case a driver is also provided and car is also provided, 900 per month will be added as driver's salary. If driver is also provided along with the motor car, then 900 per month is provided as driver's salary. So Himani says, sir, larger car ki value 900 per month hogi na? Yes, Himani, it's 900 per month. Yes, Anushka, 900 per month is chauffeur's salary. Chauffeur's salary is 900 per month. Okay, SPD, you are absolutely right. You know, 50,000 per annum is a very, very bare minimum, minuscule kind of salary, which is there for every employee now. So that definition is actually a vague definition. In current standpoint, that is a vague definition. You are absolutely right. Now, if more than one car are given for official and personal use, so if two cars are given for official and personal use, if two cars are given for official and personal use, only one car will be considered for official use and personal use, and other cars should be valued as if they are entirely for personal purpose. So the crux of the matter is that two cars cannot be used for official plus personal purpose. Even if two cars are given for official plus personal purpose, we will tax at least one of the cars as fully personal use. So only one car will be taxable as official plus personal purpose use. Rest all the cars which are given are taxable as only purely for personal purpose. Even if the assessee is saying, no, I have given two cars for official and personal purpose, we are not going to calculate two cars on the basis of official and personal purpose rule. We will calculate one car from official and personal purpose rule. We will calculate the other car for only purely personal purpose rule. That is how we are going to value the two cars. If two cars are given, then only one car is calculated for official personal use and the other car is calculated for purely personal use, which means 100% of the expenditure incurred on the personal use car will be taxable as perquisite in hands of the employee. That is the rule. Okay, sir, got it? So yes, guys, this was the perquisite on motor car. This was the perquisite on motor car. Okay, sir, got it. Now let's move on to the next perquisite. Next perquisite is free education to family members of the employee. If free education is given to family members of the employee, if the office or the company has its own schools which are running, in which the daughters and sons of the employees are studying free of cost, then that is also a benefit which is extended to the employees. Now, what will be the taxable value of that perquisite? That is what we are going to discuss now. Okay, all right. So free education to family member of employees. Now, facility owned or not owned by the employer, whether the facility is owned by the employer or the facility is not owned by the employer, in both of the cases, if the facility is given to the children of the employee, then guys, perquisite cost of such education in similar institution minus 1000 per month per child is the value of taxable perquisite. So if facility, whether the facility is owned by the employee, whether the facility is not owned by the employee, in both the situations, guys, if the facility is given to children of the employee itself, then perquisite value is cost of similar education in similar institute. So whatever similar institutes are there in that particular area, whatever is cost of education over there, that will be the perquisite in hands of the employee, because we will assume that if employee would have admitted his child, his ward, in a school which is located in the periphery, similar kind of school, then he would have incurred certain expenditure. So that expenditure which he would have incurred will be taxable as perquisite in hands of the employee. Only 1000 rupees per month is exempted in this particular part. 1000 rupees per month is exempted in this particular part. Other family members, if the education is provided to other family members who are not children of the employees, then perquisite is cost of education in similar institute. We won't give the exemption of 1000 per month in this particular case. Then it says no restriction on number of children. Any number of children can be there. S means perquisite taxable only in hands of specified employees. So this is taxable only in hands of specified employees. And I've already proved that, almost all the employees of today's companies will be specified employees. Now, when other family members are there, then when the facility is owned by the employer, perquisite is taxable only for specified employees. So guys, in this case, when family members are being provided education facility, then guys, in this case, when the facility is owned by the employer, then the perquisite is taxable only for specified employees, not for all the employees. So if the facility is owned by the employer and the facility is provided to family members of the employer, then it is taxable only in case of specified employees. Like in case of children of employee, guys, in that case, only the specified employees are taxable in that particular case. But in case the education facility is given to other family members of the employee, then it is taxable only when the facility is owned by the employer and perquisite is given to the other family members. Then it is taxable only in hands of specified employees. Next is reimbursement of education expense to the employee. So if a certain employee is actually making its children study in a particular school, okay, and the school fees is reimbursed by the employer, then guys, it is fully taxable for all employees, including central government employees. The reimbursement of education facility is fully taxable for employees, all employees, including the central government employees. It is fully taxable. Okay, sir, got it? So these are small perquisites, guys. We have already done the major part of the perquisite in our earlier lecture. We have already done it. Okay, now movable asset of employer. In case of movable asset which is given to the employee other than motor car. Okay, this is other than motor car. Motor car we have already studied. This is other than motor car. If any other movable asset is given to the employee, then what will happen? Use by the employee. If it is given just for use by the employee, if it is owned by the employer, the asset is owned by the employer, or the asset is hired by the employer. If it is owned by the employer, then perquisite is 10% of the original cost. Use of computer, laptop, etc. is not taxable. So if computer, laptop, etc. are given to the employee, then it is not taxable as perquisite in hands of the employee. Use of motor car is not included here. Even use of motor car is not included over here. If the assets are hired by the employer, then what will happen? Perquisite value is the hire charge paid by the employer. So whatever expenditure the employer is undertaking on behalf of the employee, that entire expenditure is taxable as perquisite in case of movable assets if they are taken on rent, if they are taken on lease. Second, if the assets are being sold to the employee, sometimes what happens is the old assets which are belonging to the company are sold to the employees. Employees are given those assets either free of cost or at a very, very minimal price. Then what will happen? Perquisite will be WDV minus the sales price. So if sales price is less than the WDV, then only perquisite will arise, right? So if the WDV is 10,000 and you have sold this particular WDV to the employee at 9,000, so you are giving him 1,000 rupees benefit. A thing which is worth 10,000, you are giving it for 9,000, you are giving benefit of 1,000. 1,000 will be taxable as perquisite. Now WDV is to be calculated using the rates which are given in this particular schedule and not the usual rates which are given in PGBP chapter. Okay, you will forget the depreciation rates which are given in PGBP chapter, and the depreciation rates which are used for calculating the WDV will be these rates: electronic items or computer 50%, motor car 20%, any other asset 10%, and SLM method. No depreciation to be charged for part of the year. If the asset is only being used for a part of the year, then don't charge any depreciation on that particular asset. This is the same rule which we have already studied in PGBP, guys. In PGBP also, if the asset is being used for part of the year, depreciation is ignored for that part. Okay. Okay, sir. Next is, all right, medical facility to employee or his family, especially when the employee is going outside for getting the treatment done. So medical facility to the employee or the family of the employee. What is the value of perquisite in this case when medical facility is provided to the employee or the family of the employee? Provided inside India, if the medical facility is provided inside India, guys, in case of non-government employee, medical facility maintained by the employer, if the medical facility is maintained by the employer, or expense incurred in specified hospitals for specified diseases, then it is fully exempt from tax. We are not taxing this perquisite in hands of the employee. If the facility is owned by the employer or maintained by the employer is maintaining the facility, employer is maintaining the dispensary or the hospital or the clinic, then nothing shall be taxable in hands of the employee. Employee will be given this benefit free of tax. Nothing shall be taxable in hands of the employees. However, if it is not owned by the employer, if the facility is not owned by the employer, then what will happen? That is the next rule which we are going to study now. Okay, in case of government employee, hospital is maintained and approved by government. So if the government employee is taking treatment in any of the government approved hospitals, it's absolutely free of tax. No tax is levied on it. It is absolutely free of tax, fully exempt. Okay. So in case of non-government employee, that is private employee, medical facility maintained by that particular employer, that will be taxable in hands of the employee. And if expenses incurred in specified hotels for specified diseases, which is approved by CCIT. CCIT is Chief Commissioner of Income Tax. So if the specified hotels are approved by the CCIT and the specified diseases are also there, then that is fully exempt. In case the medical facility is provided outside India, that is very, very important, guys. Then, there has to be traveling outside India. The medical facility in, say, Italy are very, very strong. So there's a disease which is curable only in Italy. In that case, provided outside India, the employer provides the medical facility outside India. Medical expense and cost of stay of patient and one attendant. This is exempt up to RBI permission. So medical expenses of the employee, if it is reimbursed by the employer, right, and cost of stay of patient and one attendant is reimbursed by the employer, it is not taxable in hands of the employee if it is to the extent which is permitted by RBI. Cost of travel of the patient and one attendant. So this is cost of travel. Guys, this includes only cost of stay and medical expense. This includes cost of travel, okay? Cost of travel of patient and one attendant only. If you have two attendants, the amount is not exempt. If you have two attendants. Exempt if gross total income of the employee, excluding the cost of travel, is less than or equal to 2 lakh rupees. So if that employee is a very, very low salaried employee and the employer is actually doing a favor by extending some help to the employee for getting the medical treatment done, then the cost of travel is exempt if the gross total income of the employee is 2 lakh rupees, less than 2 lakh rupees. Family means, what do you mean by family? Family means, so we have used the word family over here. The expenses of the employee or his family are as per these rules. Family means spouse, children, parents, sibling, wholly mainly dependent. Okay, spouse and children may or may not be dependent. However, parents, siblings should be wholly and mainly dependent on the employee. Only then the amount of expenditure will be fully exempt. Medical allowance is fully taxable. So any kind of medical allowance which is given to the employee, it is fully taxable. No exemption for any medical allowance. Allowance means when the amount is reimbursed in terms of money, and money is given to the employee, that is allowance. Okay. So if allowance is given, then it is fully taxable. No exemption at all. All right, guys. So these were the perquisites which were there in our syllabus. So I have tried to cover majorly all kind of perquisites, right? majorly your kind of allowances, all important allowances and perks that I've tried to cover in the earlier two lectures, today's lectures and the earlier lecture. Next topic which we are going to start in the next session is retirement benefits. Retirement benefits is next which are going to start. Retirement benefits. So a very, very important session. You cannot afford to miss this session at all. You cannot just afford to miss this session. This is going to be one most important session for your CMA Intermediate preparation. So quickly join in, send the link to your friends, ask them to join in as well. And yes, before we start the session, just hit a like button, thumbs up button, just hit that like button. And yes, we will start the session now of retirement benefits. I very much hope that you have attended the first session properly and you have also given the test. Yes, test was organized on this Sunday and many students, almost 200 students had attended the test on Sunday. It was scheduled on Sunday in the evening, 7 p.m. of salary chapter. Apart from retirement benefits was not discussed. Apart from retirement benefits, all other topics of salary chapter were discussed in this particular test, which was organized on Sunday. So if you want to participate in the test series, then guys, test series is available on the mobile number, which I'm writing on the screen. Just message on this mobile number and request them to add you in the WhatsApp group where the test series is being organized and where the test series is being conducted. You will be sent a link just before the test series, and yes, the details of the test series will be given to you on the WhatsApp group. And needless to say, guys, the schedule is fixed every Sunday 7 p.m. Every Sunday 7 p.m. your date sheet is out. 27th June your date sheet is there. Until June we will continue this test series every Sunday 7 p.m. There is no doubt about it. The only thing is what topics, sir, will you give in the test, that I will disclose in the WhatsApp group itself. Most likely the topics will be same as the revision which I am conducting over here. Whatever revision I'm conducting over here, those topics will be taken up in the test series. That is the usual trend. Okay, if there is any deviation to this trend, you will be informed in the WhatsApp group. All right, so be a part of this WhatsApp group, guys, which is available on this mobile number. So just WhatsApp on this mobile number and request them to add you in the WhatsApp group. And yes, every Sunday test. Until which date? Until June. Obviously, we won't go till end of June, but yes, at least till mid of June, we'll be having test of all the chapters. Then we'll be having test of the entire syllabus once. That is the agenda that is on the cards. Secondly, guys, accounts live session is today at 11:30 a.m. Just immediately my session gets over. After 1 hour, we'll have account session, financial accounting session. That live session will also be there. I hope you have already seen the earlier live session which is there of accounts, which has been uploaded on my channel as well. Please join the account session today as well. Today the live session is immediately after my live session, financial accounting session. That will also be there. And all the sessions will be hosted on two YouTube channels, CSC CMA Nikkhil Gupta, which is this channel, and the channel of Bright Vision Academy. Please subscribe to both the channels and be a part of both the test series or the information which are given in either of the channels. Please be part of that. All right, so today we are going to start one of the most important topics of your syllabus, guys, retirement benefits. As the word itself suggests, retirement benefit means the benefits which are given to an employee post his retirement. Post retirement, the benefits are given to the employee, and post retirement the benefits which are given to the employee, those are known as retirement benefits. So retirement, as you are aware that in India, you know, retirement age is 60 or 65 depending upon certain professions and certain companies. So either it is 60 or it is 65. So 60 or 65, that is the age bracket within which a person gets retired. And if a person gets retired, then guys, income tax, the employer of the person gives him some benefits, give him some lump sum consideration, so that his old age can be can be advanced or can be fulfilled in a good way, in a proper manner. So that is what is retirement benefits. The sole objective of retirement benefit is that once our employees attain old age, then they need not be dependent on someone else for their daily needs. Okay, that is the purpose of retirement benefits. So retirement benefits, the purpose is that After retirement, you get some lump sum consideration, some lump sum amount, so that you are not dependent on anyone else for your financial needs, for your resources. That is retirement benefits. Now the question arises that, sir, how would this retirement benefits be taxed in hands of the employees? Now, how would the retirement benefits be taxed in the hands of the employees? That is the question that comes up in our mind. Okay. Yes, absolutely, guys. That's exactly the question which we are going to dwell with in this particular topic, in this particular chapter, in this particular session. That, what should be the taxability of these retirement benefits? Sir, if I was the Income Tax Act, I would have exempted all retirement benefits from tax. I would not have taken any retirement benefits from tax. Why would you have done so? So I would have done so because retirement benefits are the benefits which are for some good purpose. Okay, even when the employee is not working, he's being offered some money so that his old age is secured. So, sir, out of philanthropical considerations, out of my soft corner for helping out someone. So if I were the Income Tax Act, I would definitely, I would not have charged any of the retirement benefits to tax. Guys, a very good thought. Indeed, I will use this thought in my discussion of retirement benefits. In the entire session, I'll be using this thought of yours. Please park this thought. But unfortunately, soon as we give exemptions, as soon as we give benefits to employees, guys, employees start misusing those benefits. Employees start disguising those benefits. They start misusing those benefits. So to avoid employees from misusing the benefits, to avoid employees from not treating the retirement benefits in their essence, we have made certain regulations. Obviously, we will keep your emotions in mind also. Your emotions that, sir, retirement benefits are given once and for all, sir. Please don't tax them. Please keep them exempt. We'll keep this emotion in mind while determining the tax laws. But guys, we also have to curb the tax evasion. We have to curb the tax avoidance, with which many over smart people do. So we will also do that. So yes, both the things will be kept in mind. All right. So guys, in this particular session, we are going to deal with these kinds of retirement benefits. So there are retirement benefits which are written on the board, and these are various kinds of retirement benefits. Okay, first one is provident fund. Provident fund means that an amount, a specific amount is allocated by the employer in a separate fund, in a separate account, and that particular fund keeps on accumulating along with the interest. It keeps on accumulating, and once the employee retires, at that point in time, that amount, lump sum amount, is given to the employee. So that is known as provident fund. What is gratuity? Gratuity means the provident fund is being accumulated each month or every year. That is provident fund. But gratuity is also a lump sum consideration which is paid after retirement. The only difference is there is no contribution which is done by employer each year for this gratuity. Yes, some employers can do it, but most of the employers don't do this provision which they create. Every month they are contributing some amount to a separate fund like provident fund. It is not being done in case of gratuity. So gratuity is second kind of retirement benefit. Third is leave salary encashment. Leave salary encashment means once you are retired, then whatever is the accumulated balance of your leaves which you have not taken. Suppose you were eligible for taking 20 leaves per annum, but you did not take 20 leaves per annum. They got accumulated. Your leaves got accumulated. Now the employer has offered you, either you can take these leaves or you can get them encashed. You told them, I want money, I want to get them encashed. That is known as leave salary encashment. Then pension. Pension, as we all are aware, is a fruitful source of income for the old age people and the retired people. Pension means every month you will get some part of your salary, even after retirement, when you are not working for that company or that PSU. Even then you will get a fixed amount of money every month, which will be a percentage of your salary, and generally the percentage is 50% of basic salary is given as pension. So that is known as pension. But guys, a pension in nowadays, in modern world, in the current world, pension has been discontinued by Government of India. Earlier the pension was there as a part of the salary structure or the retirement structure, but now pension has been discontinued. Pension is no more a part of salary structure of Government of India. Earlier it was there. But yes, guys, even for people who had joined earlier, so in the year around 2000 2001, this pension was discontinued. But before that, whenever the whosoever has joined government organization before that, guys, those are eligible for pension. So definitely we need to study the taxability of pension, because today there might be certain individuals, there might be certain people who are eligible for pension. So pension is one of the retirement benefits, which is a very, very important retirement benefit, which is available with us, which is given away as income for old age people. Pension is definitely there. Okay, sir, is pension prevalent in private sector also? Guys, usually no. Usually private sector doesn't give any pension. Usually private sector doesn't have any pension scheme or something like that. So pension is usually not given by private sector. That is the usual trend which is there. Okay, pension is of two types: commuted, uncommuted. When I come on to pension topic, then I will discuss the pension types of pension, commuted and uncommuted, that I will discuss over that or at that point in time. Then there is retrenchment compensation. So some compensation is given as retrenchment compensation, which is the compensation which is given once you are you are before your retirement, you are asked to leave the company. If you're asked to leave the company before your retirement, then you are paid retrenchment compensation. Retrenchment compensation means before you retire, then you leave the company. That is known as retrenchment compensation. So retrenchment compensation received on cancellation of contract of service. Whenever your contract of service gets cancelled, at that point in time, whatever compensation is given to you, that is known as retrenchment compensation. Compensation received at the time of cancellation of contract of service. Whenever the contract of service gets cancelled, at that point in time, retrenchment compensation is given. The next one is voluntary retirement compensation. So, sometimes what happens is that a person is not willing to work till the age of 60. He asks for voluntary retirement, that even before I attain age of 60, I want to retire from the company. I want to have benefits which are there, which are available to retiring person. And before that only I will have to. So Shri Vidya, salary encashment can come at as a part of retirement benefit, as well as as a part of normal emoluments also. So if a leave encashment happens on an annual basis, okay, then that is not a part of retirement benefits. Then it is a part of normal salary disbursement. But if it is given after retirement, if the company is giving a leave encashment after retirement, then that can be discussed with retirement benefit also. So it can come either ways. Okay, it can come either ways. Okay, next one is annuity. Guys, since pension is no more in prevalence now, Government of India doesn't give pension to the people who are joining the government service as of now. Since pension is not prevalent as of now, there's a concept of annuity which has come into play. There's a concept of annuity which has become popular. And guys, this concept of annuity is periodical receipts of money over a period of time. So just like pension was there earlier, now the concept of annuity is there. Suppose if you pay certain amount of money to a fund, and that fund will then promise you to pay on a monthly basis a particular amount till the end of your life, till your death. That is known as the annuity. So annuity is a substitute to per se substitute to pension. But the point is that pension, in case of pension, there was no fund which was created by the employee. But in case of annuity, there is a fund which is created by employee or the employer to monetarily fund the pension which will be given to you after a point of time. So annuity is a kind of emolument which will be given to you after a point of time on a fixed periodical basis. All right, but for annuity you need to contribute something. Either your employer will contribute something today, or your employee or the employee will contribute something. All right, sir, got it? So this was the gist of the retirement benefits which we are going to discuss in this particular session. And the first and foremost retirement benefit that I'm going to start now is provident fund. One of the most important topics of your retirement benefit, one of the most important topics, which is provident fund. So what do you mean by provident fund? That is what we are going to discuss now. हाँ जी अंजलि, बिल्कुल अमेंडमेंट के साथ हो रही है. ऑब्वियसली अंजलि, जब आज की डेट पे हो रही है तो अमेंडमेंट के साथ ही होगी ना. ऑल राइट. सो provident fund are of 4 types. There are 4 types of provident fund. Number 1, statutory provident fund. Number 2, recognized provident fund. Number 3, unrecognized provident fund. Number 4, public provident fund. There are four kinds of provident fund. What do you mean by fund? So fund means a pool, right? Like a swimming pool, okay? You have seen big swimming pools, okay? So fund is like a pool where money is accumulated, money is pooling together, and then the money is used for benefit of the people who are pooling in the money. That is known as a fund. Fund means anything which is being accumulated, that is known as a fund. So provident fund, the first type of provident fund is statutory provident fund. And guys, this provident fund is exclusively reserved for central government and state government employees. It is governed by PF Act 1952 and CIT approval is required before forming this kind of a fund. So, government is regulating this kind of a fund. CIT appeals is regulating this kind of a fund, and the rules and regulations, the provisions, the bylaws of these funds are governed by Government of India. That is the PF Act 1952 and CIT appeals. These two combined together govern this statutory provident fund, and it is a very, very regulated, very, very strict kind of provident fund, applicable only and only to central government and state government employees. Number two is recognized provident fund. This is applicable to non-government employees like private employees, and of course this is also covered under the realms of PF Act as well as the CIT approval. So recognized provident fund is made for private employees, not for central and state government. And it is also regulated. It is also governed by bylaws, okay? It is also fully regulated by law, by the PF Act, and CIT approval is required. So why is a governing law required in such kind of a fund? Why do we need a law? So we are contributing some amount of money every month in like a fixed deposit. We will get a return after some point in time. Why do we need laws intervention? Why do we need an act to govern this fund? Why do we need CIT appeals to CIT to regulate this fund? Why do we need Commissioner of Income Tax to regulate this kind of a fund? So why do we need it? The requirement is that, sir, this fund shouldn't be misutilized. Suppose there's an employer is X Limited. Suppose there's an employer, name of the employer is X Limited. What is X Limited doing? X Limited is X Limited has many employees. X Limited has many employees. X Limited is collecting fund from these employees and it is depositing to a fund called Provident Fund. Okay. Now suppose if this fund is not regulated by law, this is just like a fixed deposit. Okay. Suppose it is not regulated by law, then there is a possibility that at a future point in time, X Limited withdraws money from this fund and uses it for its benefit, for its use, right? But this money belongs to the employees. This is known as misutilization of funds. The employer at a later point in time, if it misutilizes the fund for its own benefit rather than giving benefits to the employees, this is known as misutilization of this provident fund. Since this particular amount is belonging to the employees, there has to be a safeguard, there has to be a law, there has to be provisions, there has to be bylaws which protect this fund, and therefore the requirement of protection is there in these funds. These fixed deposits belong to the employees and we have to ensure that employer doesn't misutilize them, and therefore there's a requirement of CIT approvals. There's a requirement of Provident Fund Act which should govern these funds which are being created by the employer or Government of India, as the case may be. Therefore, strict regulation, guys, strict regulation is required for statutory provident fund, recognized provident fund, any kind of provident fund. Strict regulation is required. Therefore, these provident funds are regulated by PF Act 1952 and CIT approval, Commissioner of Income Tax approval is required for these funds. All right, sir. So these are the two basic kinds of fund. Now we come on to other kinds of funds. Next one is unrecognized fund. Suppose X Limited opens a fund but doesn't get itself recognized under the PF Act 1952, nor does it get approval of CIT for this particular fund. There's no approval. There's no regulation which is governing this fund. So in the chat box, please tell me in the chat box whether this fund, which is fixed deposit, which is done by X Limited, whether this particular fund is risky for the employees or not. Yes or no, please write in the chat box. I want to know in the chat box whether this kind of a fund which is not recognized, which is not governed by law, which is not taken after CIT approval, whether this kind of a provident fund is risky from point of view of employee or not, whether it is risky or not. Yes, yes. Deepika Raj Purohit, Pankaj, Devdata, Rani, Rishika, Megha, Azam, Manav, Kirti, Deepika, Yashika, Pooja, Dibakar, Sunny, Sheshan, Vishnu, Tanisha, Saksham. Perfect, perfect answer, guys. Perfect. Everyone is saying yes, yes, it's risky. Yes, it's risky. Perfect, guys. Absolutely, it's risky. So, yes, this is a risky provident fund, unrecognized provident fund. This is a risky provident fund, unrecognized provident fund. This is known as a risky provident fund. And so, how would it impact its taxability? We are going to discuss in our subsequent lectures. Now, this fund is not approved by CIT. That is the biggest drawback of this particular fund. It is not approved by CIT, but yes, employer has opened it, and employer is contributing to this fund. Next one is public provident fund. So, guys, these three provident funds are solely for the people who are under employer-employee relationship. Only employer and employees are allowed to open these three kinds of funds. Only employer and employees. But this public provident fund is open to businessmen as well. So if you have income which is offered to tax under PGBP, or you have income which is offered to tax under house property, then guys, this particular public provident fund is for you. These three funds are only and only for salaried class employees who are having salary income, who are having employer-employee relationship. These three kind of funds are there for those three, for those kind of employees only. However, this fund is available for non-salaried class also. Like, I am not receiving any salary. I am having my business income, my profession income. Okay, so I have to contribute in public provident fund, and this fund is opened under any of the banks which are there, like State Bank of India or Oriental Bank of Commerce, or any kind of bank provides this kind of facility. It is established by central government for general public. For general public, these are established for people who have employer-employee relationship. This is established for general public. That is the difference. Okay, sir, got it. Now we come on to the next topic. Okay, let me just I'm just finding something, guys. Just give me 2 minutes. Let me just find something to show you. If I get it, I will show you. So I'm just getting it for you guys. Okay. Just a second. I'm just. I'm just showing you something, guys. Just give me 2 minutes. I have that file in my laptop. I should have had it over here as well. Let me check once again. No, that file is not here. It must be there in my laptop. Yes. Okay. So I have this file available with me, which I'm just going to open in front of you. Yes, sir. Let us open this file. Let's open Gmail. All right. Yes, guys. I have got through this file and we are going to see a particular taxability of provident fund through this particular file, which we are going to see. Can salaried employee get only any of the 3 provident funds? So it depends on your employer. It depends on your employer. So your employer should have had a kind of provident fund. Mostly the employers have provident funds which are recognized provident funds only, mostly, guys, right? But if your provident fund, if the employer's provident fund is unrecognized, then it will be unrecognized. So depends on your employer, what kind of provident fund is that employer holding. That is the key answer. Okay, sir. All right, so I've opened my notes. If you don't have my notes, that's perfectly all right, guys. That's perfectly all right. I'm just going to show you a regulation. I'm just going to show you a table. Therefore, you don't require these notes. Even if you don't have these notes, it's perfectly fine. You can also open your study mat. If you don't have these notes, you can open your study mat. Your study mat would have this particular table or this particular sections. Okay, I'm going on to the sections of provident fund, and I am in a very brief manner I will be able to explain you the taxability of provident fund. Yes, so this is the table which I'm going to refer now. All right, so this is the table which I'm going to refer now. It's a very, very important table, guys. These are the kind of provident funds which we have just now discussed: statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. These are the funds which we have just now discussed with all of you: statutory provident, recognized, unrecognized, PPF. Okay, now please understand one very important thing, guys. So when you are in employment, so suppose I am in employment from 2010 to 2070. 60 years I have been an employee of a particular company. I have been employed in 2010 until 2070. I have been employed with this particular company. So guys, every year, the employer is going to contribute something in the recognized provident fund. Every year, employer is going to contribute something, a small amount in the recognized provident fund. Suppose that amount is 3,000 rupees per month. So from 2010 till 2070, my employee will contribute 3,000 rupees per month to a separate fund, which is in the nature of fixed deposit. So I'm just giving you an example, like fixed deposit is there. It will contribute, and at the end of 2070, when I will retire, I will get this lump sum amount in my pocket, in my hands. Okay, so lump sum amount I will get in my pocket. But guys, the crux of the matter is that in the year 2010 to 2070, when this amount was contributed by the employer in a separate account in name of the employee, at that point in time only, the income has been earned by the employee, so to say. Income is not earned in the year 2070. It has been earned during this particular period when the fund was created, right? So now, obviously, guys, income cannot be taxed twice. One income cannot be taxed twice. So this cannot be a situation where Income Tax Act says, okay, while contributing this 3,000 every month, you should add it to your income and pay taxes on it. And you should also pay taxes at the end of 2070 when you actually receive this money. This cannot be a situation. So Income Tax Act will tell us that at what point in time the taxation will accrue. Either it will accrue when the time when the contribution was being made from 2010 to 2070, during this particular period when the contribution was being made, you know, either the tax accrues or the income accrues either during that period, or it will accrue at the end of 2070 when I will actually receive this amount. So there can be these two situations which will arise, and that is what is determined by the Income Tax Act. When should the provident fund be taxed? Either it can be taxed when the contribution is being made by the employer, which is 3,000 rupees per month, or it can be taxed at the end of your retirement period, which is 2070. So either of the two things are possible in case of provident fund. That is what we are going to discuss using this particular table now. Before coming on to table, one more aspect, guys. Employee is also supposed to contribute an equal amount to the provident fund. Employee is also supposed to contribute an equal amount to the provident fund. I'll give you an example. Suppose employees per month salary is 50,000. Suppose employees per month salary is 50,000. Okay. Employer contributes. Please listen to the question carefully. Employer contributes 3,000 per month to Provident Fund. Next aspect. Employee contributes. Okay. Employee contributes 3,000 per month again to the Provident Fund. Employee contributes 3,000 again to the Provident. Manav, it will always be given in the question whether PF is recognized or not. Question will always specify whether it's recognized PF or unrecognized PF. All right. Now, 50,000 per month is salary. Employer contribution 3,000. Employees contribution 3,000. In the chat box, after giving it a thought, a pure Shanti, peaceful thought. After giving it a thought, don't be in haste, okay? Answer my question. What is the monthly salary of this particular employee if I tell you that I will tax Provident Fund at the time when it is being contributed? What is the total income of this particular employee? I've given you three facts. Basic salary, the salary is 50,000. Employer's contribution 3,000. Employee's contribution 3,000. What is the total salary of this particular employee per month? If I'm telling you that the PF contribution will be taxable at the time when the contribution is made, at that time the PF will be taxable in hands of employee. What should be the total income? What should be the total income of this particular employee? 50,000 is salary, 3,000 employer's contribution, 3,000 employees contribution. What is the total taxable salary of this particular employee? Wow, Pankaj Kumar. Pankaj Kumar is one of the most notorious students of my class, but when it comes to studies, he focuses maximum in his studies. Very good, Pankaj. Sheshan Kumar, very good, Sheshan. Yashika Jotwani, very good. Deepika Raj Purohit, very good. Tanisha Kanojia, very good. Ravi Gupta, very good. Pooja Jangman, 53,000, very good. Shri Vidya, 53,000. Vishnu, perfect. Perfect, guys. Kriti, Anushka, Shreya, Om, Kakati, Kirti, Ishita, Khimani. Perfect. Very good answer, guys. Very good answer. The answer is 53,000 per month. Sir, the question is, why not 56,000? Why not 56,000? The reason is that, guys, this 3,000 is being extracted from here. This 3,000 is not a separate contribution. This 3,000 is being extracted from the salary of the employee. So actually the salary which is given to the employee is after deducting this 3,000. So only 47,000 is given to the employee. So this 3,000 is forming part of this 50,000. This 3,000 is getting extracted from 50,000. Therefore, the total salary of the employee will be 53,000. 53,000 will be the total amount of salary which is there. Answer is not 56,000. Many students think that answer is 56,000. No, answer is not 56,000. Answer is 53,000. Because salary plus employer's contribution will be the total salary. Employee's contribution will be extracted from the employer's salary itself. So this is the total salary which will be taxable in hands of the employee. Okay, now you got the concept. Now we directly jump onto this table. This table is the most important table in this particular topic, guys. You have to absolutely learn this table wholeheartedly. You have to learn this table. I'll give you two options. Okay, option number one, mug up this table, ratify this table, and you will forget this table in 1 month or 2 months, or maximum till your examination you will remember it. After that you will forget it. Option number one, mug it up, mug up the taxability. Option number two, I will give you certain logics. I will give you certain ways to remember it. Certain stories I will make. Maybe they are hypothetical stories. Maybe they are, some cooked up stories. But I will tell you a story using which you, if you remember this table, you are going to remember this table for your entire life. Two options are there. Option one, option two. Which one do you want to choose? Option one or option two? Please write in the chat box. Please write in the chat box. Devashish Raut. Oh, thank you so much, Devashish. You are a student from 2013 batch. You were a CMA final student. Okay, great. Option one, option two. Which one do you choose? Tanish says. Rani Singh says one. Okay, Rani, then you don't listen to this particular discussion. You close the video for a short while. Good morning everyone, and welcome to this session of income from house property. This is one of the small chapters of your syllabus, guys, but yes, from an exam standpoint, a very important chapter for intermediate students, because in the exams, a question of say about 6 marks is expected to be there from this particular chapter. And yes, it is an important chapter from a theory as well as practical standpoint. So both the standpoints are important in this chapter. So we are going to start income from house property today. Vihan, good morning. Jyotish, good morning. Neha, Gokul, Abhishek, Nandini, Shriyan, good morning. Good morning, everyone. Good morning. All right. So now we are going to start our one of the most important chapters of our syllabus, which is income from house property. And yes, income from house property, as the name itself suggests, guys, house property income means income which is derived from any kind of house property. So if you have a house property, if you have a building, if you have a land which you give on rent or you plan to give on rent, then that rental income will be taxed as income from house property. So yes, there are certain nitty-gritties, certain critical factors which are to be kept in mind while taxing the income from house property. That is important. So those factors are to be kept in mind. And in this particular chapter, we are going to study all those factors which are to be kept in mind while calculating the taxable income from house property. So yes, let's start. What is the brief introduction? What are we going to study in this particular chapter? This chart will tell us that. So what are we going to study? That's what is entailed in this particular chart. So number one, applicability. To whom is this chapter applicable? To what kind of income is this particular head applicable? What kind of income is taxable in this particular head? It is, we are going to study two things: that you should be an owner of land and building. You should be an owner of land and building to have this income from house property accrues only to those people who owns land and building, land or building. So what if I own plant and machinery? Would I not be taxed under this head? Answer is no, you will not be taxed under this head. So to be taxed under income from house property, you need to be an owner of land and building. That is the two prerequisite conditions which are required to be fulfilled to tax your income as income from house property. Then how do you compute your income? What is the computation of income in case of house property? How do you compute that income? So guys, we will divide this computation of taxable income into few parts. Parts are: number one, let out property; number two, occupied property; number three, partly self-occupied and partly let out property; number four, deemed to be let out property. So guys, whether your property which you have, which you own, which is land and building, either it is occupied by you, which is self-occupied, or it is let out to someone else. It is given on hire, it is given on rent to someone else. Both the incomes will be taxable under income from house property. Sir, what is this, sir? This is unfair, absolutely grossly unfair. Sir, this is wrong, sir. Sir, when we have a self-occupied property, when we are occupying that property, when we are staying in that property, so why should we pay taxes on that property in which we are staying? So this is wrong, this is incorrect. We cannot pay taxes on the property in which we are staying, in which we are we and our family is staying. So this is incorrect. How can you tax a property which is self-occupied? So we understand, and we are very much with you when you say that whenever you let out your property, you will be having taxable income and you will be taxed. We are with you, sir. But sir, we don't like this thought that occupied property, self-occupied property is also taxed. So we did not like this fact. I agree with you. I am fully with you in your emotional outburst which is there. Absolutely, guys. This emotion is absolutely correct. But yes, there was a dire need to tax the self-occupied property in certain cases because people went over smart. People went out of the way to save taxes, to control on their taxes. They went out of the way and they started misusing the provisions of law. Therefore, the law introduced certain provisions to curb tax evasion, and therefore self-occupied property came into net of taxability. We'll discuss. I'll definitely keep these emotions which you have in my mind. Definitely these emotions will be respected while teaching. I will tell you your emotions are absolutely valid, and I will not let your emotions go for waste. Your emotions will be duly considered. That's if you are self-occupying certain property, so that should not be taxed because there's no income. Okay, agreed, point taken. So guys, sometimes there can be a partly self-occupied property, partly let out property. So half of the portion of the property is let out, half the portion is self-occupied. That can also be a situation. And in certain circumstances, property can be deemed to be let out. What do you mean by deemed? Deemed means assumed. We can assume that this particular property is let out even when it is not let out. We will assume in certain circumstances that it is let out. That is the deeming fiction, deemed to be let out house property. Then last thing which we are going to study in this particular chapter is deduction. So guys, this was income. How is the income calculated under income from house property? This was section number 1. Section number 2 will deal with expenses. What kind of expenses are we going to reduce from the income? The expenses are only 2 kinds of expenses are allowed. First is the standard deduction. Standard deduction, as we had already studied in a salary chapter also, irrespective of any expenditure incurred by the assessee, this deduction will be available to all the assessees. It is known as standard deduction of 30%. Whether you incur any expenditure or not for house property, for maintaining house property, we will allow you this deduction. It is standard deduction. Secondly, we have interest on loan. So, for purchasing this particular house property, for buying this particular house property, you might have taken certain loan, and on that loan, you might have paid certain interest. So we will tell you what are the limits according to which you will be able to deduct this particular interest on loan from your income. So these are the expenses, these are the incomes which you are going to deal with in this particular chapter. One very important thing which we are going to deal with, what will happen to recovery of area rent? So area rents means rent which are pertaining to the previous year. Due to some dispute between the landlord and the tenant, the rent was not received by you. Now, if past areas are recovered in the current year, how to treat them, how to tax them, that is what we are going to discuss in this particular topic. All right, sir, got it? So now, guys, let us first of all understand these 2 words. Okay, 2 words are very, very critical. First is the owner. Second is land and building. Okay, owner and land and building. What is the meaning of these 2 words? Because these 2 words will be the basis of our taxability. They will determine whether the income will be clubbed under the head house property or not. So we are going to see what are these 2 words. First word is house property. Guys, house property only means land, building. No plant machinery, no commercial complexes, no places where commercial things are going on, etc., etc. So commercial buildings are allowed. Of course, commercial buildings are allowed. So land and building. So apart from land and building, no other property is termed as house property. No other property is termed as house property apart from land and building. So land means a land which is surrounded by wall with or without roof. Having a roof is not necessary, with or without roof, but it should be surrounded by wall. So if there is a land like a farm, that is not eligible to be called as land and building. Land means a land which is surrounded by a wall. At least it should have a periphery. Then appurtenant to building, a land which is attached to the building. Appurtenant means attached to the building, like parking, approach road, backyard, etc. So vacant land is not house property. If the land is left vacant, it is not house property. What is building? Building means residential or commercial building, any kind of building. It should be a permanent structure, not a temporary structure. Okay. If you have constructed something temporary, that is not building. Roof not necessary for non-residential house property like stadium, swimming pool, etc. So it's not necessary that we should have a roof for certain commercial properties like stadium, swimming pool, etc. Incomplete ruined house is not house property. So a house which is not complete, which is not completely made, that house property is not termed as house property. Or one which is ruined. Ruined means which is under shackles, which is absolutely deserted. Okay, remains of some old house property, that will not be termed as house property. So house property should be a proper house property. Then what do you mean by ownership? Now this is a critical one, guys. Ownership will include legal owners as well as beneficial or deemed owners, or any kind of owner which is beneficially using the property. So there are 3 aspects to ownership. Number 1, legal owner. Legal owner is the registered owner, which is there on the papers. Okay, whose name registry is made for this particular house property, that is known as the legal owner or the registered owner. Registered owner is the first category of ownership. Second is the beneficial owner. Beneficial owner means the person who is currently not the legal owner or not the person having registry, but he is enjoying all the benefits of the house property. He is known as the beneficial owner. So guys, usually registry takes a lot of time. Okay, but before the registry takes place, sometimes the possession of the property is transferred to the future owner. In this particular case, beneficial owner will be chargeable to tax under the head house property. Chargeability will accrue to beneficial owner, despite of the fact that he is not the legal owner on the papers. So who is enjoying the property like an owner? Who's enjoying the property like an owner? He is the beneficial owner. Third is deemed or fictional owner. Third is deemed or fictional owner. In some situations, owner is Mr. A, but we will assume that owner is Mr. B. Let me repeat. In certain cases, owner is Mr. A, but we will assume that owner is Mr. B. So this is absolutely incorrect. This is absolutely wrong, sir. How can you assume someone else as the owner when A is the owner? How can you assume B as the owner? Guys, let me explain. There are certain cases where the transfer of property takes place, but in effect, the transfer has not taken place. I'll give you an example. Transfer to spouse, minor child without adequate consideration. So if you are transferring your property to a spouse or to a minor child without adequate consideration, you have not taken adequate consideration from your spouse or your child. In that case, we will deem you as the owner and not your spouse. So I'll give you an example. Mr. X transferred a property worth 1 crore rupees to Mrs. X at 10 rupees. Let me repeat. Mr. X transferred a property worth 1 crore rupees to Mrs. X at 10 rupees. Inadequate consideration. Inadequate consideration. In this case, Mr. X will be deemed to be the owner of the property, although the legal owner of the property, the registered owner of the property is Mrs. X. We will refuse to take Mrs. X as the owner. Mrs. X is not the owner. Mr. X is the owner. Transfer of to spouse or minor child without adequate consideration. Then holder of impartible estate. So a person who is holder of impartible estate, an estate which is belonging to multiple people, that estate belongs to multiple people, but that estate is not partible. We cannot part the individual parts of that particular estate. So for example, there is a huge factory. 4 brothers own that factory. That factory is a consolidated unit. You cannot break that factory into 4 parts. All the 4 brothers are having equal share in that particular property, but the senior most brother, the elder most brother, is holding that particular estate and running that particular estate and has got the power from doing everything. So despite of the fact that the legal owners are 4 brothers in equal sense, but we will consider that brother who's holding this impartible estate as the owner of this particular property, because this estate is impartible. We cannot partition this asset into various parts. Therefore, the holder of the impartible asset, despite of the fact that that asset has got multiple owners, even despite of that fact, the holder of impartible estate will be the deemed owner. Next, property held by a member of a company or society or AOB under a house building scheme. Now, this is a very, very important aspect, guys. Sometimes the companies, big conglomerates, big MNCs provide facility to stay under the house building scheme to its employees. So, property which is held by a member of company, society or AOP. So, under the house building scheme, companies provide house to stay to the employees. The employees will get the house to stay, but the house is actually in name of the company and not the employee or not the member. But there is an agreement between company and the employee that over a period of time, some amount of salary will be deducted from the employees or members or the AOP BOI partner who's there. The salary or their portion will be deducted and the ownership will be transferred in their hands in long run. Sometimes this may happen. So under a house building scheme, if you hold a property, you means a member of a company or society or AOP, you hold some property. Actually, it is the owner of that property is AOP, but it will be deemed that you are the owner because eventually you will be the owner. Eventually you will be the owner. The company has allocated that house to you and is withdrawing your salary every month, holding your salary for payment of that particular house. So in effect, that house belongs to you. So in case your property is held by a member of a company, society, AOP, BOI, under the house building scheme, then guys, it will be deemed that your property is in your name, in the employee's name or in the member's name or in the person who's having a society in his name. The property will be taken into consideration. Then person who holds property in part performance of the contract. So what happens is sometimes a person holds a property under part payment of contract. I'll give you an example. So I have purchased a property worth 50 lakhs in Delhi. Okay, I have paid 20 lakh rupees to the seller and I've told him, please transfer this asset to me. I will pay the property in a short while. I will pay the balance amount in the short while. Okay, so that person tells me that okay, you pay the money, rest of the money in the short while, and we will transfer the asset in your name after that particular payment is done. All right, now the part payment has already been done. Person who holds the property in part performance of contract. So part payment has already been done and I have been transferred the property, possession of the property, but the legal ownership has not been transferred to me. Even in that case, guys, I will be deemed to be the owner of the house property and the income will be chargeable under my head, because part performance will definitely convert into full performance at one point in time. So even if you've done part performance of a contract, even then the property will be deemed to be your property for the purposes of income from house property. Then lease which are for more than 12 years. If you are entered into a lease for more than 12 years, then we will deem that this property is your property. This property is not someone else's property. This property is your property. Then we will deem it. So Kirti Patra says, what if child is major and the property has been transferred without? Oh yes, in that case, the deeming fiction doesn't apply. In that case, the deeming fiction doesn't apply. Dhruv Jain, good morning. Dhruv Jain is late today. Capital gain will arise there on the basis of SDV. Where? Jyotish, where are you saying capital gain will arise? I don't understand your question. Capital gain will arise there on the basis of SDV. I don't know. Okay, next. One important aspect of taxing an income under the head income from house property is that house property should not be used for business purposes, should not be used for profession. If that house property is used for profession, if that house property is for business purposes, then guys, it will be taxed under PGBP head. It will not be taxed under house property head. So it should not be taxed. It should not be used under business or profession. So if the house property is used for purpose of business or profession, it is not taxable as income from house property. For example, letting out to employees, ancillary units, government agencies. So if you are using your house property for business purposes, it will not be taxed as house property. It will be taxed as income from PGBP. That is the point of consideration. All right, then guys, this is an easy topic. This is also an easy topic. I'll come to computation of income directly. All right, so let's start the computation of income of let out property. And yes, I'll be sharing these slide decks with you so that there are small slides which are very easy. I mean, just look at this list. You must have already studied this list. Exempted properties, list of exempted properties which are exempt from income from house property head. So this list I'm not discussing in the live session, but I will provide this PDF to you. You please go through this list because there's nothing to explain in this list. So I will provide the entire deck to you. Please go through this deck carefully. I'll directly come on to the most important calculation, guys. Most important calculation of your house property chapter. And yes, from an exam standpoint, it is very important from an exam standpoint that you understand this calculation very well, because this calculation will form the basis of your a question which will come in the examination. This is the most important calculation which is there in your syllabus, and it will come to a very large extent. It will come for sure. I mean, there's no doubt about it that will come in your examination. All right, so let's start computation of income of let out property. So if you let out a property, then your computation of income will be there. All right, now my first question to you. Okay, my first question to you. Income from salary. Okay, we have already studied income from salary. Your hands on the keyboard. Your hands on the keyboard, and you have to answer me this question. Income from salary. Suppose someone is earning salary of rupees 7 lakhs per annum. Suppose someone is earning salary of rupees 7 lakhs per annum. But that person is capable of earning 10 lakh rupees per annum. According to his qualification, according to his experience, he is capable of earning 10 lakh rupees per annum, but currently he is at a salary package of 7 lakh rupees per annum. Please tell me what should be his taxable salary. Don't go into computation and all. Just tell me what is his taxable salary. Should it be 7 lakh or 10 lakh? Should it be 7 lakh or 10 lakh? That is the question that I'm going to ask to you. Please answer me in the chat box. Ravi, I will come to your question at the end of this lecture, okay? Difference between area-wise division and time-wise division. I will come to it. A person is earning a salary of 7 lakh rupees, but he is capable of earning, according to his qualification, according to his experience, he is capable of earning salary of 10 lakh rupees, but due to Corona, there was no avenue where he could earn his salary. Therefore, he accepted offer of 7 lakh rupees. What is his taxable salary? It is 7 lakh rupees, 7 lakh rupees. Mansi, Ishita, Nitish, Sri Lakshmi, Akanksha, Fawaz, Dhruv, Nagnath, Kirti, Meraki, Jyotish, Yashika, Gaurav, Vanshi, Deepika, Rajpurohit. Absolutely correct. Absolutely correct. Now my second question to you. My second question to you. Please listen to my second question very carefully. There is a house property. There's a house property. I have a house property. Where? In Lakshmi Nagar in Delhi. I have a house property in Lakshmi Nagar in Delhi. I gave that house property on rent at 15,000 rupees per month. I gave that house property on rent to some CA students or CMA students at 15,000 rupees per month. But I know that that building is capable of earning me 20,000 rupees. That building is capable of earning me 20,000 rupees. But as of now, since there was Corona time, so I compromised on my income. I said, okay, take the property in 15,000. I gave away the property in 15,000. The property which could have fetched 20,000 to me. Okay. My question to you is, what is the taxable house property? What is the taxable house property? Dhruv Jain. Any other answer? What is the taxable house property? Pankaj says 20,000. Sri Lakshmi 15,000. Kartike 20,000. Okay. Who else? Varsha 20,000. Oh my God. Varsha is online. Wow. Varsha has started studying back again for the June attempt. Brilliant, Varsha. So guys, Varsha is very, very active on Instagram. Her reels are very, very active and she's an Instagram star sort of. So she doesn't get much of time to study. But it is really good that she is getting time out of her busy schedule of having Instagram reels. She's having time to study. That is very, very good. Ravi says 20,000. Tadwai Nandini says 15,000. Vanshi says 20. Nitish says 20. Aditi Kumari says 20. Exactly, guys. Exactly my point. This is the basic difference between any other head and income from house property. Income from house property doesn't tax the actual income. It taxes the income which could have been received by the assessee. It doesn't tax the actual income. It doesn't tax the actual income. It actually taxes the income which could have been received by the assessee. It taxes actually the notional income. The income which could have been received by the assessee, that is taxable under the head income from house property, and that is the moot point of consideration. That is the moot point of difference between any other head and income from house property. So, according to Income Tax Act, it says that income from house property will be taxable at an amount higher of what is actual rent or the rent which could have been received. Please understand these two concepts. Please understand these two concepts very well. Income from house property. I will tax rent. I will tax any property at a higher of the rent which has been received or the rent which could have been received. The rent which has been received or the rent which could have been received. Higher of both these amounts will be taxed as income from house property. That is the moot point of consideration in case of income from house property. Yes, that is taxing of notional income. This is known as notional income. I have earned only 15,000 rupees, but I am paying taxes on 20,000 rupees. Let me repeat. I have earned 15,000 rupees, but I am paying taxes on 20,000 rupees. That is the concept of income from house property. Very, very different concept from any other accounting, from any other head of income. PGBP, capital gain, income from other sources, salary. No other head talks about this notional income, but income from house property talks about notional income. It doesn't tax your income which is received. It doesn't tax your income which is received. It taxes your income which could have been received. That is the concept of income from house property. So let's start the computation of income from let out property. This is the way we calculate income from house property. So first of all, we calculate the gross annual value, which is known as the GAV. We will compute the method of computing GAV. We'll discuss it in a short while. Then we reduce municipal taxes from this GAV to get net annual value. Municipal taxes are taxes that are paid by the assessee. Advance tax is not deductible. So municipal taxes are reduced. Then we get a figure of NAV, net annual value. From net annual value, we deduct two expenses, okay? Sir, what if we incur any other expense apart from these two? Will it be allowed as a deduction? Answer is no. Only these two expenses are allowed as a deduction from income from house property. No other deduction is allowed from income from house property. Only these two are allowed as a reduction from income from house property. Standard deduction at the rate of 30%. Interest on loan under section 24B. This is allowed. Finally, we reach at the figure of income from house property. The final figure is income from house property. That is the residuary figure. And we apply tax rates on this particular final income. Now, in this particular session, we are going to deep dive into each of these things. What are these things? How are they computed? That is what we are going to discuss in this particular session. Okay, so context is set. And yes, Pankaj Kumar is absolutely right. Higher of RER or ARR. I'll tell you the full forms in a short while. All right. So the basic figure on which our income from house property is taxed is gross annual value. Now, what is this gross annual value? Gross annual value is a higher of actual rent receivable, the amount which has actually been received by you. For me, it was 15,000 in my example. 15,000 rupees has actually been received by me, or reasonable expected rent, the rent which I expect to be received, the rent which according to that particular area, Lakshmi Nagar, what is a reasonable rent which is expected out of me? That is reasonable expected rent. So this is the expectation. This is the reality. Whichever is higher is taxable. This is the expectation. What I should have received, what I could have received. This is the expectation. And this is the actual rent which is receivable. A higher of both of them will be taxable as gross annual value. Higher of both of them will be taxable as gross annual value. So higher of reasonable expected rent or actual rent received, higher of these two will be taxable as income from house property. Okay, sir. Now, sir, we very much understand what is actual rent receivable. Okay, sir. We have no doubt in it, sir. So it's very, very simple. Actual rent which has been received by me after giving this property on rent. This is very, very simple, sir. This is very, very okay. But, sir, how should we know the expected rent? How should we know the expected rent? What is the expectation of the rent? What rent is expected out of a property? How should we know that, sir? Now, to compute that, Income Tax Act has given you a formula. Let's see what is the formula. So, reasonable expected rent is a higher of gross municipal value or fair rent. So, what do you mean by gross municipal value? Gross municipal value means the municipality of that area must have fixed a particular rate for that particular property. That is known as gross municipal value. Whatever rent, whatever rate that particular area municipality has fixed for this particular property, that is known as gross municipal value. And guys, this is given in law books. Okay, there are books which are there, there are acts, there are stamp duty acts, there are acts which are there. You will find this particular value from that municipal valuation book. Okay, next is fair rent. Now, sir, what do you mean by fair rent? Fair rent means rent fetched by similar property in similar locality. So rent which is received in similar property and in similar locality, that is known as fair rent. So what do you mean by fair? Fair means reasonable. Okay, fair means reasonable. According to that locality, according to that property, what should be the fair rent of this particular area? That is fair rent. Okay, so higher of fair rent, that will be the reasonable expected rent. But guys, this higher has to be subject to maximum of standard rent. So reasonable expected rent cannot be higher than standard rent. Sir, what do you mean by standard rent? Guys, standard rent means the rent which has been allocated under the Rent Control Act for a particular area. So what do you mean by Rent Control Act? So guys, when the country was liberated during independence era, at that point in time, state-wise rent control acts were implemented, whereby rent was sealed up to a upper limit. There was ceiling which is levied on rent. So rent of, say, Delhi, of central Delhi, and that to a particular district or area, cannot exceed a particular amount. That was the Rent Control Act. So control acts, when they were implemented, they had a standard rent clause which said that the rent of this particular area cannot exceed this particular rent. That is known as standard rent. So the reasonable expected rent is higher of municipal value or fair rent, subject to maximum of standard rent. So first you will compare these two. First you will compare both of these. Then whatever is higher, you will compare it with standard rent, and it cannot be more than standard rent, right? That is the formula for reasonable expected rent. Now, there's one very important thing, guys. One very important thing. So standard rent is the maximum rent as per the Rent Control Act. So what do you mean by standard rent? It is the maximum rent as per the Rent Control Act. That is the standard rent. All right. So now we will compare these two figures. We know how do you compute reasonable expected rent. We know how to compute actual rent receivable. We will compare both of these, and whatever is higher will be the GAV, gross annual value. We will put this figure over here, and then we will reduce municipal taxes from this particular amount. We will get NAV. Then we will reduce the standard deduction at the rate of 30% of NAV, and interest on loan we will reduce to get income from house property. That is how we compute the income from house property. Okay, sir, got it? All right. So guys, we have already studied the income part of it. How is the income part calculated in case of a house property? How do you compute the part which is income part, which is gross annual value, net annual value? How do you compute that part? Now we come on to the two deductions which are there in house property income. Now please tell me, house property standard deduction is 30%. Okay, house property standard deduction is 30% of NAV. This is the law. Okay, your hands on the computer, your hands on the keyboard. All right, answer to my question. Okay, my question is, my actual expenses on maintaining this property is 40% of NAV. What deduction should I be allowed from NAV as standard deduction? Please write in the comment box. Please write in the comment box. Sahil Pahuja says hi. Hi, Sahil. Sahil has joined late. Please let me repeat my question. Okay, I've already told you that standard deduction. I've already told you that standard deduction is 30% of NAV. Standard deduction is 30% of NAV. That is what I've already told you. Okay, please tell me if my actual expense which I'm incurring on this building is more than 30%. It is 40%. Then what will be the deduction which is allowed under standard deduction? What deduction will be allowed under standard deduction? Okay, perfect. Very good. Pankaj, Jyotish, Srinath, Nagnath, Deepak, Nandini, Kirti, Srinath, Nitish, Ravi, Vanshi, Kartike, Ravi Gupta, Gauravanand, Varsha, Kirti Batra. Perfect. Question number 2. Kartike. Perfect. Question number 2. Dhruv Jain. Perfect. Maximum is 30. Question number 2. Please listen to my question number 2 very, very carefully. My actual expenditure is actually 20% of NAV. It is lower than 30%. What will be my standard deduction? My actual expenditure is lower than 30%. It is only and only 20%. What will be my standard deduction? My actual expenditure is less. What will be the standard deduction. Surya Kiran says 20. Yashika says 30. Jyotish says 30. Vishnu says 30. Kartike says 20% only. Okay. Sakshi says 20. Srinath 30. Deepak says 30. Nandini 30. Ravi Gupta. So Nandini says 30%, sir, whatever. What is whatever? I don't understand what is whatever. Oh, Dhruv Jain says 20%. Srinath says 30. Deepika says 20. Sajan says 30. All right, all right. So guys, please read to the words very, very carefully. Irrespective of actual expenditure. It doesn't matter whether my actual expenditure is 20% or 40%. It doesn't matter. The deduction, standard deduction which I'm going to get is always 30%. Examiner will try to confuse you by giving you actual expenditure which will be lower than 30% of NAV. Examiner might try to confuse you, but no, you are not going to get confused. Why? Because you know that standard deductions are always eligible irrespective of actual expenditure. Actual expenditure is to be ignored. So whether the actual expenditure is less, whether the actual expenditure is more, you will get a deduction of entire 30% of NAV. That is the answer. Okay. All right. Perfect. Right. Now I move on to the critical part. Critical part is interest on loan. Now guys, if the property has been purchased or has been constructed using some loan from a third party and you are paying interest on that particular loan, okay, so naturally that interest is your expense. So I have constructed a house property using loan from ICICI Bank. I am paying interest to ICICI Bank. That interest which I am paying to ICICI Bank is an expenditure for me, is a deduction for me. So I'll be allowed that deduction under section 24B of the Income Tax Act, but subject to certain limitations, okay? And now we are going to discuss the limitations which are there for allowing the deduction under interest on loan. So we start our topic of interest on loan. We start our topic of interest on loan. Now, before coming on to this particular topic, let me just give an example to you. Let me just give an example to you. Okay, sir. All right, so guys, this is a timeline which I have created, okay? This timeline starts over here, and then the timeline has various dates which are there, okay? So I start with the date 1st April 2022. This is 31st March 2023. This is 31st March 2024. This is 31st March 2025. Okay. So I decided to build up a building and I decided to take up loan for that particular building on 1st of April 2022. I decided to start a building. Okay. 31st March 2023, 31st March 2024, my building got completed in this particular year. In middle of the year, the building got completed. The building got completed on 15th of May 2023. The building got completed on 15th of May 2023. This is the completion date of the building. Building got completed on this particular date. Now guys, I took a loan on 1st April 2022. So the period of interest would have started from 1st April 2022. So period of interest would have started from 1st April 22 and it would have extended till the time I repaid the loan. So suppose I repaid full loan on 31st March 2025. I repaid full loan. Full loan was repaid to me. So now interest is accumulated or interest is given for this entire period. If the interest is given for this entire period, guys, first of all, I need to bifurcate this entire period into pre-construction period or post-construction period, because I need deduction of the expenditure of interest, right? So first step that I'll take is I will divide this period into pre-construction period or post-construction period. Now, sir, what is pre-construction period? Guys, pre-construction period is before 15th of May 2023. So before 15th of May 2023 is the pre-construction period. But tell me something. tell me something. Would it be difficult for you to compute the pro rata interest from 1st April 2023 to 15th May 2023? Will it be difficult to you? Yes, sir. Slight difficulty will be there. Some, but pro rata we will do, and we will compute the interest which is for this particular period. Okay, guys. Now I ask you another question. Suppose this date was not 15th May, it was 23rd May. Now tell me, would that pro rata become a little more difficult? Yes, sir. Now that pro rata will become more difficult because now we have to prorate on the basis of number of days. Sir, a very, very tedious task. Sir, a difficult task. So Income Tax Act has resolved your difficulties. Income Tax Act has made it very simple. What has Income Tax Act said? Income Tax Act has said that whenever your completion happens in middle of the year, whenever your completion happens in middle of the year or somewhere in the year, the immediately preceding 31st March should be taken as the completion date. So immediately preceding 31st March will be taken as the completion date. So this 31st March will be assumed as the completion date for ease of calculation. We don't want you to prorate the interest amount. Okay. For ease of calculation, we are doing this to you. So immediately preceding part of 31st March will be taken as your completion date. So your pre-construction period will be from 1st April to 31st March 2023, and your post-completion period will be from 1st of April 2023 to 31st March 2025, till the time you repay your full amount of loan. I hope you can see the full chart now. Yes, you can see the full chart now. So the period from 1st April 2022 to 31st March 2023 is the pre-construction period. For ease of your calculation, the income tax had ignored the middle of the year dates which are there, pre-completion or post-completion. So they have ignored the part of the year. Part of the year has been taken as the full year of post-completion part, right? So whether it happens anywhere in this particular year, the pre-completion period will be 31st March 2023 only. Now I have a question. Suppose the actual completion date was 31st March 2024. Suppose the actual completion date was 30th March 2024. It has been shifted a bit, right? Now what will be the deemed completion date? Please answer in the chat box. What will be the deemed completion date if the completion has started on 30th, if the completion has been done, the building has been completed on 30th March 2024, then what will be the completion date, assumed completion date? What will be that? Please write in the chat box. I want the answer in the chat box. Perfect. Very good, Pankaj. Very good, Jyotish. Very good, Varsha. Superb. Very good, Rinki. Kirti Batra. Very good. No, Rinki is wrong. Ravi Gupta, very good. Aditi Kumari, very good. Gaurav Anand, very good. Superb, guys. Yes, guys, this is the moot point of consideration. Whether completion happens during middle of the year, beginning of the year, or end of the year, the completion date will always be assumed as the previous year end date. Okay, sir, we got this concept. Now, sir, we didn't understand one very important thing. Yes, please tell me, what is that very important thing? Sir, why have we bifurcated our period into pre-construction period and post-construction period? Why have we bifurcated, sir? What is the use of bifurcating this two periods? So guys, I have a question to you. Okay, building got completed in the year 2023-24. Okay, building got completed somewhere in the year 2023-24. Now please tell me, interest was being incurred from this particular year. But building got completed in this year. Please tell me, from which year will the income accrue from this property? Will it be the year? I'll give you two options. Will it be financial year 2022-23, or will it be financial year 2023-24? What will be the year from which the income will start accruing? Will it be the year 22-23, Will it be 22-23 or will it be 23-24? When will income accrue? From which year will the income be accruing? From which year will income accrue? Income from house property will be taxed. Financial year 22-23 or financial year 23-24? Which year? Pankaj Kumar. Very good. Kartike. Very good. Perfect. Perfect, guys. The income will start accruing from 23-24. So tell me something. If the income will come from 23-24, if the income will come from 23-24, that means income of 22-23 will be 0. Then is there any use of deducting interest from this income? Because the income is 0. When the income is 0, how will you match your expenses and income? So the pre-construction interest will go for a waste. Pre-construction interest will go for a waste. Therefore, what will we do? We will accumulate the pre-construction period and we will allow it as a deduction in the subsequent period, which is the post-construction period. Please understand the logic. Why are we doing it? So that you are able to remember it well. Why are we accumulating pre-construction period interest? Please understand the logic. Only then you will be able to remember it. So pre-construction period, there is no income, there is 0 income. When there is 0 income in pre-construction period, guys, then it will be difficult to have a deduction, because deduction can happen only when there is income. Some expense will happen only when there is income. Okay, when there is no income in this particular period, the pre-construction period, then there is no use of interest, there is no use of deduction. So what will we do? We will accumulate the pre-construction interest and we will allow it as a deduction in post-construction period. Post-completion period, we will allow it as a deduction. That is the reason why we bifurcate the interest into 2 parts: pre-construction interest, post-construction interest. Okay, sir, got it. All right, let's come back to our main calculation, main concept, guys. And the main concept is that we have to allow interest on loan. Interest on loan is to be allowed by us, and interest on loan is to be reduced under section 24B. All right, acquisition, construction, repair, reconstruction of the property. These are the purposes for which interest on loan is allowed as a deduction. There are 3 uses to it. Pre-construction period, interest will be there. Post-construction period, interest will be there. Pre-construction period will start from commencement of construction or date of borrowing, whichever is later. So commencement of construction, whenever the construction will commence, or whenever the borrowing is done, whichever is later is the start date of pre-construction period. The end date of pre-construction period is 31st March of the financial year prior to the year in which construction completes. So the year in which construction completes, immediately preceding year end is the completion date of pre-construction period. Amount of deduction: accumulated interest to be allowed in 5 financial years in the year of construction completion. So after the construction completes, after that, in 5 years, the accumulated interest is to be given a deduction for. So pre-construction period is reduced after the completion of the building. After the building is fully completed, only after that, pre-construction period interest will be allowed as a deduction. Then what about post-construction period? Guys, post-construction period means income is accruing in that particular year, right? So whatever interest is accrued, that is allowed in the same year. Okay, yes, sir. When will the year start? It starts on the 1st April on the financial year in which completion completes. So whenever the construction completes, the beginning of that year will be treated as the post-construction period. End date will be when the loan is fully repaid. When the entire loan is repaid, then it will be the end of construction period. Then amount of reduction is allowed in respective year on an accrual basis. So every year, each year, the interest will be allowed as a reduction of post-construction period. So each year, the amount is allowed as a deduction. Okay, sir, got it. So this was interest on loan part of it. Okay, sir. All right. Now we come on to the self-occupied property, and I know you are very emotional about the self-occupied property. You are very emotional about the self-occupied property. So before I start the section, okay, before I start the section, let me have an emotional voting from all of you. Please be as emotional as you can and vent out your emotions, okay? My question to you is, the property which is self-occupied by a person, that particular property should be taxable or it should be not taxable? Please answer in the comment box. I'm talking about self-occupied property. I'm not talking about let-out property. I'm talking about self-occupied property. Please answer my question whether the self-occupied property should be taxable or should be not taxable, according to you. and you can have your emotions in place. Okay, the emotions which you showed in the beginning of the session, those emotions, I want them back. Self-occupied property, property which you own, which you stay in, should it be taxable on the expectation that what rent would have been fetched if this property was given on hire? Should it be taxable or should it not be taxable? That is the question which I'm asking. Everyone is saying a no. Everyone is saying a no. All right. Dhruv Jain has become actually emotional. He's sending an emotional emoji along with no. Dhruv Jain is actually emotional. Mayur Shah saying no. Kirti Batra, Siddharth Gupta, Karishma, Gadda, Midi, Surya Kiran, Siddharth Gupte. Everyone is saying no. Ravi Gupta, not taxable. Okay. So I'll tell you what. You are over smart people. How are you over smart people? You are over smart because if you have, say, 4 house properties and you are aware that out of those 4, if you stay in one of them, balance 3 are given on rent. If those properties which are given on rent are shown as let out property, then they will be taxable. And if they are shown as self-occupied property, then they will not be taxable. You know about this particular fact. You know about this particular thing. Then guys, you will become more smart. What will you do? You will disclose that all the properties are self-occupied properties. All the properties are self-occupied properties. That is the tax evasion which you will do. That is the tax evasion which a normal person does. If he has 3 or 4 properties, some of them might be vacant also. They would say that, oh, all of them are my self-occupied property. That is incorrect. So Government of India says it respects your emotion. First of all, first things first, self-occupied property should not be taxed. Government of India agrees with it. Government of India agrees with it. Self-occupied property should not be taxed. Government of India agrees with it. But only to the extent of 2 self-occupied properties. So, first of all, let me tell you, fully self-occupied property, NAV is 0 up to extent of 2 self-occupied properties only. So, only 2 self-occupied properties will be tax-free. NAV 0 means tax-free. There will be no NAV. There will be no NAV. So, if there is no NAV, there is no tax, right? So Government of India is saying, we accept your emotions. You are an emotional person. We accept your emotions. Your emotions are absolutely correct. We don't mind giving you a relief on self-occupied property. But don't be over smart. Don't be over clever. Only 2 properties, only 2 self-occupied properties will be exempt from tax. So NAV is 0 only up to the extent of 2 self-occupied properties. NAV will be 0 only to the extent of 2 self-occupied property. If I have 3 self-occupied properties, if I have 3 self-occupied properties, and yes, there can be a situation where I have 3 self-occupied properties. I have a big family. I have a huge family. So, I have 3 wives. Yes, I have married thrice. Please don't say that, sir, legally it is not possible or whatever. I'm not talking about legal thing, but I'm talking about emotional thing now. I have 3 wives. So I have 3 houses allocated to them. 1 week I stay in one house, 2nd week I stay in 2nd house, 3rd week I stay in 3rd house. I have 3 houses. I have 3 wives. All 3 of them are self-occupied by my family. It's all my family. But Government of India is saying we will treat only 2 out of these 3 as self-occupied, and we will give a tax freedom to only 2 out of 3 of your buildings. We will not be able to give tax relief to the 3rd building. Only 2 will be considered as NAV as no. All right. Yes. Then what happens if the property is partly self-occupied and is partly used for some other purpose? If the property is partly self-occupied and it is partly used for some other purpose, then what will happen? Karthikeya is saying, Chota Parivar, Sukhi Parivar. Try it. Karthikeya, have you already tried? I think Karthikeya is already having a Chota Parivar. He's married. I think he's not a CMA student. Huh? He's already married. He's got experience. That's why he's saying try it. Okay. Now the question is, what happens if the self-occupied property is partly self-occupied and partly vacant? Then guys, if it is partly vacant, so suppose a property has 2 floors, 1 floor is occupied by the owner, 2nd one is vacant, then guys, it is treated as fully self-occupied property. So entire property's value is 0. Property let out, half property is self-occupied, half is let out. Then what happens? Partly treated as self-occupied and partly treated as let out. So we will divide the income into two parts. Partly self-occupied, that income will be exempt from tax, and partly let out, that income will be taxable. Third is partly used for business and partly used for self-occupation. Then what happens? Partly treated as self-occupied and partly treated as PGBP income. So we'll treat it as partly. We'll divide the entire value into two parts. First part, self-occupied, will be exempt. The second part, which is PGBP or let out, that will be taxable. Okay, sir. Then monetary limit on interest on borrowed capital for self-occupied property. Now this is very, very important, guys. And let me reiterate. The interest which is taken on let out property, interest on loan which is taken on let out property, that interest is eligible for a deduction for an unlimited amount. Okay, there's no restriction on the amount of deduction. So loan interest can be 10 lakh, 20 lakh, 30 lakh, any amount of interest will be allowed as a deduction. But in case the loan is taken for self-occupied property, if the loan is taken for construction or purchase of self-occupied property, then the interest on loan is restricted to a certain amount. Loan or capital borrowed for acquisition or construction, if the loan is borrowed for acquisition, or if the loan is borrowed for repair, renewal, and extension. If the loan is borrowed for acquisition or construction, then if you fulfill these three conditions, then the loan interest will be eligible up to 2 lakh rupees. If you do not fulfill these three conditions, then the loan will be eligible only for 30,000 rupees. And if you have taken loan for repair, renewal, and renovation, then only 30,000 rupees deduction will be eligible for interest. In case of let out property, unlimited amount, guys, unlimited amount. 2 lakh, 3 lakh, 4 lakh, 20 lakh, 50 lakh, 100 lakh, 10 crores, whatever interest you are accruing, entire amount will be allowed as a deduction. But in case of self-occupied property, there's a restriction of 2 lakh rupees on the monetary amount of deduction for interest on loan. So what are the three conditions? Three conditions are: loan should be taken after 1st April 1999. And means cumulatively all three conditions should be satisfied. Construction should have been completed within 5 years, and third, certificate from the lender regarding utilization of loan should be acquired by you. If these three conditions are satisfied, then the interest will be allowed to the extent of 2 lakh rupees. Otherwise, the interest will be allowed to the extent of 30,000 rupees. So yes, you might have incurred interest of say 6 lakh rupees per annum, but the deduction will be eligible only for 2 lakh rupees per annum. You might have incurred interest of 4 lakh rupees per annum, but the deduction will be only restricted to 2 lakh rupees per annum. Now my question to you is, your hands on the keyboard, okay, your hands on the keyboard, please answer my question. The actual interest paid by you, is 1,50,000. You are fulfilling all the three conditions. What is the eligible deduction? Is it 1,50,000 or is it 2 lakh rupees? The actual interest which is incurred by you is 1,50,000 rupees. The deduction which is allowed is 2 lakh rupees. You are fulfilling all the three conditions. What will be the deduction which will allow to you? Will it be 1,50,000 or will it be 2 lakh? Because guys, in a standard deduction, although the actual expenditure was less, even then I allowed 30%, right? That is why I'm asking this question again to you. Will it be 1,50,000? Will it be 2 lakh? Actual expenditure is 1,50,000. So what will be the deduction? Yashika, Srinath, Mohammad Azam, Aditi Kumari, Karishma, Deepika, Kirti, Kartike, Preetam, Nitish, Jyotish, Israt, Ravi Gupta. Perfect, guys. Your answer is absolutely right. The answer is 1,50,000. Guys, it is only and only in case of standard deduction that we forget about actual expenditure. It is in the case of standard deduction that we forget about the actual expenditure. In case of any other deduction apart from standard deduction, we take care of the actual expenditure as well, and the deduction is limited to actual expenditure. So the actual expenditure, which is 1,50,000, is allowed as a deduction in this particular case. If the actual expenditure is less, then we are going to allow lesser amount of deduction in this case. That is the thing. Okay, sir, got it? Okay, this box is important. In case of let out property, there is no limit on deduction on interest. So interest deduction will be allowed for an unlimited amount if the property is let out and not self-occupied. Okay, sir, got it. Then last topic of our syllabus, guys. Last topic, what will happen if past rent is recovered? Last topic. What happens if past rent is recovered? Recovery of unrealized rent. Section 25A. If past year's rent is recovered, past year's rent 2 lakh rupees was due to be received by us from our tenant. Tenant didn't give us at that point in time, but now tenant has given it back to us. It may be for the reason of court case has been adjudicated in favor of us. It may be the case that the tenant has got some realization, some oman or some babaji or guruji has given some guidance to tenant that don't have any dues on your head, that will you have to repay that in your next birth. Some babaji must have some guruji must have given this pravachan, given this seek to our tenant, and tenant gave us our rent which was due 2 years back. Okay, it was areas of 2 years back. The tenant has given us our rent back. What will happen of that particular? Muhammad Azam says if actual expenditure is more than 2 lakh, then 2 lakh exemption, 50,000. So yes, Azam, absolutely right. If the expenditure is 2,50,000, then 2 lakh will be allowed as a deduction. Deduction will be 2 lakh. 50,000 will be waste. 50,000 will not be allowed as a deduction according to Income Tax Act. So yes, the recovery of unrealized rent is taxable in the year of receipt after allowing standard deduction of 30%. In the year of receipt, you will allow this particular deduction, and yes, standard deduction of 30% will be allowed to you from this particular income. Taxable on cash basis. This is the first parameter, that it is taxable on cash basis. Taxable in the year of receipt, even if recipient is not the owner in that particular year. So guys, there's a possibility that in that particular year you might have sold off that particular house property. You are not the owner of that house property in the year in which your tenant is giving you the rent, because you have sold that property long back. Okay, so at the time when you had this property, at that point in time tenant didn't give you the money, but now when you have sold this property, tenant is giving you money, arrear money of last year's. It doesn't matter whether you are the owner of that particular property in the current year or not. Doesn't matter. You will be allowed you will have to charge this income under income from house property after giving standard deduction of 30%. No other deduction is allowed. So no other deduction is allowed. So if you ask me, interest on loan, no, it is not allowed. Interest on loan will not be allowed if it is a case of unrealized rent. So yes, guys, this was our chapter on income from house property. In brief, I've tried to touch upon all the critical aspects of this particular chapter. All the important top points of this particular chapter I've tried to touch base upon in this particular session. If you like this session, then please hit a like button. Please hit a like button. That will definitely motivate me